Good morning, everybody. Good morning and welcome to the Fun Zone. How's everyone doing today? Morning, Abe. Good morning, Miss D, Ron, Erla. Great to see you guys. Hope everybody is doing wonderful. Life is treating you right. Those of you on the East Coast, hope you're staying dry and have electricity, right? Hey, Rob, other Mark, Adriana, Morgan, and Paul. I like it. Hope everyone's doing awesome today. I'm ready. This week for me has been like all about study. Actually, about the last 4 weeks have been all about study. Got a jet ski. Wouldn't that be fun? We used to inner tube through the streets in Houston when there were tropical storms in our neighborhood. The back of the neighborhood, we'd go tubing down the street. Fun stuff when we were kids. Good morning, Zorro. Man, I've been doing a lot on patterns this week. It's been fun. Hopefully you guys are just focusing on patterns too. Because that really is what we do. Had an awesome class yesterday with some great questions. And I think that one of the things that I realized that maybe I don't say enough is there's a really easy way to do it in the beginning, guys. There's a very focused way to do it in the beginning. And the goal of this classroom each and every day is to put you in a position where you can be profitable. The learning process, I'm going to tell you right now, I'm still in the learning process. My brother, who wrote the software 27 years ago, is still in the learning process. You'll never get out of it. Don't believe that there's a finish line. There is no finish line. You're just going to keep getting smarter. It's kind of great how that works. But the goal is that you begin your journey with no sound. Son of a gun. Hold on. All right, there's the microphone reboot. Did that work? Good. So some of you are good and some of you are not. Give me a Y if you can hear me, please. Okay, so Hamid, you have it, which means that I work. All right, guys. One sec. There we go. Let's see. Let's do this real quick. I'm coming back. Nobody panic. Nobody panic. It's funny that Discord does this right in the beginning, almost every day. And I know it's not my end because at least one of you could still hear me, and I'm not sure if you guys can even hear me right now. All right, guys. All right, are we good? Can you hear me? Sorry to kick all you guys out. Just got to remind you who's boss, you know? Hamid, you were the only one with me today. Everyone else was against me. And I've got OBS working just fine, which means that we should have the YouTube video today, guys. Yeah, Rob, third time's the charm, for sure. Remember, guys, the goal, and I've got more people coming back, but the goal is to put yourself in a position where you can be profitable while you continue the education process. That's the whole thing that this beginning is dedicated to. A couple basic chart reads to help you get to where you want to be. As people shuffle back in, sorry, I had to boot everybody out. Checking news this morning. Guys, there's not a whole lot going on in the wonderful world of news. There is Wednesday, August 7th, crude oil inventories at 10:30 a.m. So for my crude oil traders, that's impactful. And that's really about the only time where I will let low impact news convince me not to trade the market for a moment, is when crude oil inventories comes out, because there's people that are going to jockey for position and there's people that are going to react to that number. And I just don't want to be in front of it. It's you this time. It's not me, it's you. So guys, I check news every morning. I just don't want to step in front of high impact news, and I don't want to step in front of medium impact news. I just want to have it nice and smooth and flowy. Everything that I talk about, really guys, does anyone have it? Anyone hear me at all? Hamid's got me. How could... Let's see if we can get them squared away, guys. Steve's no audio, but if David and Hamid can hear me, so David and Hamid, this message is for you, then it's not me. Then it can't be me. So guys, kill it and come back. Sounds great there. I like that. Thank you, Hamid. You know, I always assume that it's me that's the problem, but it doesn't seem to be. So we'll wait for people to come back. Until then, Hamid, let's just talk trash about everybody. You too, David, you're in on it. Not really. Not really. It's going to be a good day. It is going to be a good day. I'm excited about a good day. I'll start the slideshow. We'll change it up today. How's your trading going, Hamid? You don't post like you used to, which means you're either really confident or you just said to heck with it. Hopefully you're really confident. How we doing? As you guys come back in, can you hear me okay? I like it when people hang out in the room even when they don't need me. It's good because, I don't know, it inspires me to see a lot of people here. Jerry S., are you back? Adriana, Ron, Muser, Morgan, can you hear me now? Just did a full reboot. Does that mean you can hear me? David H. has me. Okay. Thanks, Ahmed. Nothing. Okay. One sec. Oh, YouTubers, I apologize for you guys that are watching YouTube and wondering why I can't seem to get my poop in a group. It's not me, I promise. Discord is giving some challenges right now. And it's weird because it doesn't seem to be universal. Some people are getting it and some people are not. So thank you for your patience. Those of you that are watching on YouTube, maybe after the fact, I'm not going to kill YouTube this morning. I'm going to make sure that there is a video for everybody, and if it starts 10 minutes late, it starts 10 minutes late. So here we go. What do you guys think? Are we there? Are we getting there? Fingers crossed. You can hear it again. It's a miracle. I love it. Windows 7. I have to feed the gerbils. They're not spinning the wheels fast enough. All right, guys. We're going to get there. So everything, guys, everything that I talk about, everything that you need to be successful, And I like to use that phrase a lot. Everything that you need to be successful, I will give you today. If this is your first day, you're going to get it. It doesn't mean that on day one, you're going to be an expert, but I'm going to teach you how to study. I'm going to show you what you should be studying. We're going to talk about why you're studying it. And I'm going to give you a rock solid plan to keep you focused on the best of the best and get you comfortable with the software, guys. And every question that you have, the answers. If it's a NinjaTrader question, like a mechanics question, software user guide, opening software, closing charts, scaling charts, stops and targets, everything. And then the trading guide, as this is literally where the rules are. So if you're wondering about something, go to the glossary of common terms, see if you can find it. If you can't find it, just ask in the room. I'll give you the answer. But the focus from this glossary of common terms, guys, and it's every morning. Every morning, this is what I focus on, and I try to keep you guys focused on it as well. It's like herding cats someday, but it's a lot of fun. The high probability trade, guys, the high probability trend trade. This is a trade that typically wins 70 to 80% of the time. And this is a trade that teaches you to read your indicators, that makes it to where you can identify a couple very specific patterns that create awesome advantages. This is a trade that creates a lot of confidence in your abilities with the software, because when you're winning 70 to 80% of the time, guys, confidence is a byproduct of the memory of success. And we focus on this high probability trend trade for an hour every morning, specifically the entry, just getting into the market where the market is most likely to continue, guys. And we do this because it really does. It turns you into a chart reader. And once you can read your charts, it'll change your world. Once you can identify a couple advantages, you're going to see a million opportunities. So we focus heavily on this. And one of the things that's going to happen is when you're a chart reader, is you're going to understand where the market is likely to continue. And you're going to use this for entry points. You'll be able to say, wow, this great uptrend, even though it's pushing down a little bit, I know exactly where it's probably going to continue back up, and this becomes your entries. You'll understand where the market is likely to go, and this is going to help you set up some targets. And then I think most importantly, guys, you're going to understand where the market is likely to stop. Knowing where the market is likely to stop gives you the ability to not take that last trade when the trend is ending, to not give away money, essentially, when the trend is ending. The likely to stop areas. I checked Monday in the S&P, guys. Everybody knows there was a ton of volatility. There were 123 instances where the key areas on your charts on the S&P stopped the market cold, stopped it in its tracks and made it go the other direction. 123 instances. And you're going to have the ability to recognize those places, those key areas, before you ever get to them, guys. And we're going to do it with the high probability trend trade initially. And the high probability trend trade is really, it's not this overwhelmingly difficult trade, but it is 3 rules that you're going to need to learn. These 3 rules, each rule is designed to create an advantage. And the first rule, strong triggers, will give you the advantage of momentum. They're in yellow. Momentum pushes a market in the direction of the trend, and momentum can break key areas, and honestly, momentum can even cover mistakes, guys. So we focus on momentum first because really this is the one I think that's going to give you the biggest advantage as you're growing as a chart reader. Once you have that advantage of momentum, you're going to make sure that there's none of those likely to stop areas. You're going to make sure that you're not trading into what we call termination conditions. And if you're not, you're going to have room to your profit targets, which is a great thing because we need to be able to make money. And we're going to call this the advantage of a clear path. So we're going to take a market that is likely to continue in the direction of the trend, and we're going to make sure that there's nothing in the way to stop it. These are your first 2 rules. And once you can identify these 2 rules, the possibilities are limitless, guys. There are so many ways to take advantage of momentum in a clear path and find your way to make money in the market. But in the beginning, as you're learning the software, guys, Your third rule is going to be the entry for the highest probability trend trade that you can take. The entry for the trade that typically you win 70 to 80% of the time. In this entry, your entry will change dramatically as you grow with the software. So we're going to focus on these three rules. And these three rules happen, I want to go to this one real quick, on only two charts. There's a large chart and a small chart. You will see more charts in the room. You'll see people sometimes with 4 or 5 charts, guys, and they're not really giving themselves better information. They're just giving themselves different information. Everybody's got a different way to do things, and what you're doing right now is you're finding your way to do things. The easiest way to do it in the beginning is to let the large chart lead the way. Let the large chart define the direction of the market, and then make the choice to go with that direction. Let the large chart define the momentum in the market through rule number 1, and let the large chart let you know that the path is clear through rule number 2. And then once the large chart says, man, everything is going this direction strong and there's no key areas in front of us, we'll refine what we see on the large chart, because all of this information is going to come from only one bar. This bar right here where my laser pointer is. Pew, pew. That defines direction, momentum, and areas, guys. It's only one bar. It's a slow-moving chart. It's a broad stroke of a brush. Large chart leads the way. I was joking with my friend yesterday. She said she's going to make me a t-shirt that says large chart leads the way. I hope so. I will video shoot the room if she gives me that one, and I'll wear it the whole time. But the second chart is the small chart. It's the fast chart. It's the refinement chart. It takes that one bar, this one single bar that gets 66% of the job done, and it turns it into 20 to 30 bars, guys. And this is where you're going to be able to pinpoint exactly where the market is most likely to continue. You're going to be able to recognize this point. You're going to be able to wait for the market at that point, and this is going to define your entry for the highest probability trend trade. That's rule number 3. We use these two charts because one of the most true statements that you will ever hear as you enter the world of day trading is that you are not in control, guys. You don't know anything about what the people in charge want to have happen. Not initially. They don't send out a newsletter saying, hey, guess what? We're going to run it up. But what you can do is you can go with the large crowd. And the large crowd is the large chart. This is a reflection of what the people in control want. They will define the direction they want the market to go. They will establish the momentum. And these are the exact same people that are reacting to those key areas that you know about long before you ever get to them. And then there's the small crowd, and these guys are bigger than you. These guys have more money than you. These guys can affect change like you can't. And they love to fight the large crowd, but they fail. These guys lose their fight 70 to 80% of the time. So what we're going to do with this highest probability trend trade, guys, is we're going to let you see and be able to pinpoint exactly where their fight is most likely to end. And this will become your entry for the highest probability trend trade to go with the flow. Every day we talk about the exact same thing, and every day I give you guys the exact same lessons over and over. And there's a fast way. The low margins are back in place. Thanks, Steve. They fluctuate sometimes, guys. Post your trades in class. I can't stress this enough. Tell me what you're doing, right? Show me your chart and tell me how you're reading your indicators, guys, because every time you post in the room, it's a private session with me. Every time you post in the room, we're going to take what you did and we're going to talk about what you saw, because you're going to tell me exactly what you saw. You're going to tell me why you did what you did, and we're just going to walk hand in hand every day to make sure that you're reading your indicators correctly, to make sure that your entries are the best, lowest risk entries, that your exits make sense. And if there's challenges, we'll address them and we'll work on a solution to correct them. And the cool thing is, and my favorite part, is if there's not challenges, then we virtual high five and everybody gets to walk away from that picture feeling, man, I did it perfect. And that's where you're going to begin to develop your plan when you take those perfect trades. So we're going to learn the rules. I'm going to show you exactly what each rule looks like individually. So we will define strong triggers first, and then we'll make sure that you understand no termination conditions, and then you'll find your entry, guys. It's very much a sequential education, and there's an easy way to do it. You're going to take a lot of pictures, guys. Use the spreadsheet that Nexgen gives you. I give you the spreadsheet every day. Here's my spreadsheet. I've already put stuff in my spreadsheet this morning. There's 4 tabs down here on the bottom. It's an Excel spreadsheet. If you don't have Microsoft Excel, guys, you can go to openoffice.org, and you can have the exact same functioning spreadsheet. You'll just have to read it with OpenOffice. You get both when you download the software. There's 4 tabs, and the first tab is a trade tracking sheet. The first tab is where you're going to take everything that you do, every trade, win, lose, or draw, and you're going to drop it in here. And you're going to talk about what type of trade it is. You're going to name your trade. Because, guys, there's going to be very specific rules attached to the name of your trade. There's going to be very specific management that's attached to whatever type of trade you're taking. So make sure that you know what kind of trade you're taking. Give it a name. Even if you make up a name, it doesn't matter. You'll know the rules for it. So you're going to make sure that you follow those rules in your spreadsheet. You're going to go through and talk about what you saw and what you did. And there's a whole section dedicated to feedback from class, guys. There is instructions on how to paste pictures into the spreadsheet using the hyperlinks. And there's also a link on how to get good fast, guys. And this was courtesy of D, I believe. Thank you. Every time you take a trade, tell me what you see. And ideally, you're going to speak to yourself in terms of advantages. You're going to talk out loud, scare the dog. I have momentum. I have a clear path. Here's where my entry was. Here's where my targets were. And what's going to happen, guys, is every time you take a picture, if you go through the process of writing exactly what you see, you're creating this association between the look and the words. You're understanding your rules and you're building trust in your rules. So that's the first page, and you need to come back and study it the next day. So if you took a trade yesterday, win or lose, right? You're going to show up this morning and you're going to say, all right, let me go back and look at the 6 trades that I took yesterday. And I'm going to find what worked, and I'm going to look at what didn't work, and I'm going to talk about the things that made me feel relaxed and the things that made me nervous. And today, I'm going to focus on the things that worked. I'm going to focus on the things that kept me relaxed, and I'm going to use the feedback, and I'm going to set myself up for the day. And guys, if you go through this every day, this will take you 3 to 4 minutes every morning while you sip your morning coffee. But it's going to set you up for the day because you're going to begin to recognize these patterns over and over that you're seeing. The second tab, and we went through this a lot yesterday, this breaks down the rules for the high probability trend trade. These 3 green sections are what it looks like on your chart to have a rule met. That's it. That's all it is. It's one rule. It's not a trade. It's not management. All it is strong triggers. And this is exactly what strong triggers look like. And this is exactly what weak triggers look like. So I've given you the rule being met and then what it's going to look like when the rule is not met. And I'm going to give you a piece of paper where you can go through and fill this out and create your recognition, because recognition just comes through repetition, guys, doing the same thing over and over. And then there is the third tab. This is where every time you post a picture and it follows the rules and there's those advantages present and you're like, man, this is the one that felt easy and I'm going to do this every day, you're going to start to build your own personal trading plan. And guys, I spend an hour on entries. I spend an hour on getting into the market where the market is most likely to continue. Eventually, you're going to have to manage it. So there's a section dedicated to management pictures. You're going to begin to recognize patterns, guys. You're going to begin to see these things happening over and over and over again. And there's also a whole section on termination conditions because that is the most broken rule out there. Your goal, if you really want to get to where you want to be fast, guys, is you should make your section, favorite trades, look like the section where I've done all this work for you guys. You've got over maybe close to 400 pictures of high probability trend trades, of medium probability trend trades, guys, what it looks like to have the advantages met. And this is all Nexgen clients finding success, keeping it simple, There is your high probability trend trade entries. So when we talk about those entries, this actually breaks it down into each step. Ideas on management, patterns that repeat themselves, and a whole section on termination conditions. Once again, things that you're going to be able to recognize, a giant red flag that says, hey, don't take that next trade. The path has been the same forever, guys. Post in the room, use your spreadsheet. We're going to learn the rules. You're going to commit to the rules. Simulate, practice. Don't wait until you think you have it down to practice, guys. Belt was awesome yesterday. He said, man, I went long here. It was green, right? But every picture that you post in this room, if you say, hey, Mark, I went long because it was green. And we'll go, cool, let's look at your chart. Let's look at advantages. Let's turn every chart into a lesson. And what we'll do is we'll work ourselves towards following rules every time we trade. Initially, you're going to break them. How could you not? You're brand new. It's okay. But what we're going to do is we're going to focus you on a plan, a solid plan, rules that have been proven to win more than they lose, because there's no reason to be in the market if you don't have an edge. There's no reason to pull the trigger if you don't have something going on that you know in your heart wins more than it loses. So we're going to focus on practicing the correct rules, or getting to where we can practice the correct rules. I'm going to simplify, guys, a lot. I'm going to give you what's called the KISS plan today. And the KISS plan is designed to allow you to be profitable, to give you the highest chance of success as you continue your education, as you learn to read your charts. You've got to learn these looks, guys. You've got to learn the looks so that they become easy. So there's 3 rules. The easiest way to get to where you want to be is know what each rule looks like individually, so that you can piece it together for a trade. And that's what we're going to do this morning, is we're going to focus on these 3 rules. And we're going to recognize them. We're going to see them. We're going to take pictures of them. We're going to talk about them. And we're going to break them down individually. And we're going to take those 3 little parts and we're going to turn it into an entry, guys. So everything begins on the large chart. Large chart leads the way. And the large chart says that we must have strong trigger lines. That's it. Strong trigger lines. Well, Mark, what the hell's a trigger line, is what some people are saying. A trigger line is just a moving average, guys. There's two trigger lines. There's a small trigger line and there's a large trigger line. The dashed line is a slower moving average. The solid line is a faster moving average. Guys, I don't know anything about what creates them, how they make them so pretty and wiggly, but what I do know is that these 2 trigger lines are going to work together to help me establish the momentum in the market. I'm working on patterns, guys. That's my whole goal right now, is to recognize things that give me an advantage. And my advantage of strong triggers happens when those small triggers break above the large triggers. The large triggers are wide and the small triggers are wide. And you see that there's space in between the 2, guys. This green background lets me know that I'm in an uptrend. These small triggers above the large triggers, the space between the 2, lets me know that I have strong trigger lines. And when I have strong trigger lines, the odds are favorable for the market to continue up. This red background lets me know that the market is going down, the trend is down. And when I have a downtrend, small triggers, wide, angled down, below the large triggers, widening, angled down, the space between the 2, it lets me know that the odds are favorable for the market to continue down. So you're going to hear in this room all day long, guys, odds favorable momentum. You're going to see it annotated on a chart, OFM, all day long, odds favorable momentum. You're going to hear me ask, hey, did you have that favorable momentum? And guys, the easiest way that I've found to recognize this is odds favorable momentum looks like scissors that are open, that are ready to cut, ready to get some work done, guys. Whether the market is going up or down. Let's look at how good I've gotten at drawing scissors. But when they're open, you can cut. That's your strong triggers. That's the advantage of momentum, guys. And the advantage of momentum can push a market in the direction of the trend. The advantage of momentum can break key Fibonacci areas, and the advantage of momentum will cover some of the mistakes that we all tend to make as brand new users, guys. Momentum is the one. There are entire trading plans built solely around momentum, but momentum goes away after a while. Sellers get tired, buyers get tired, guys, and when those small triggers return inside of the large triggers when your scissors close. You can't cut stuff with closed scissors. You can only take a stab at it. When you have small triggers inside of the large triggers, guys, we call this a weakening of the large triggers. And a weakening of the large triggers means that anything can happen up or down. It becomes a crapshoot. The advantage is gone. So rule number one is going to set you up for success initially by giving you the advantage of momentum. And if I open up a large chart here, this is it right here. Small triggers outside of the large triggers. The large triggers are wide. This space lets me know that the market is likely to continue up. Smalls below the large are wide. This is a market where it's likely to continue down. And then when those scissors close, anything can happen. There's that big untradeable bounce. So rule number one, the advantage of momentum, guys. It really does. It sets the tone. Is everybody okay with this? Pretty simple concept. Most people have this by day one. When the scissors open, we're rocking out. Rule number one is met. That advantage is there. Guys, give me a Y in the room if you're with me. And if you need a little clarification, I need you to raise your hand and say, hey, Mart, let's expand just a little bit. We're good? Love it. So once we have momentum, we're already halfway done on the large chart, but we've got to look for those key areas. We have to make sure that the large chart isn't trading into what we call a termination condition. And a termination condition is nothing more than an area, than a line on the large chart, and that line can stop the market, guys. That line can create an untradeable bounce. That line is exactly where the large crowd is most likely to make a decision, whether it's entering, exiting, taking profits. Buyers and sellers will fight at these key areas. You guys are going to know about them long before you ever get to them, and you're going to have a pretty solid recipe for avoidance. The areas are just lines on a large chart, guys. Divergence high lines, it's a magenta or pink line that comes off of a pivot, and it just lets me know that there was a loss of momentum at that pivot. If I see that light blue or cyan line at a low, it's the same thing. The market goes down and up, there's a loss of momentum, and I see it visually. It lets me know that the two forces that move the market are fighting a little bit, and one of them stole momentum. There's also red Fibonacci resistance, and when the market is trending up, guys, and it hits that line, decisions are made. This is a line that could stop the market. This is a line that could create an untradeable bounce. This is a line that may reverse it completely. And when the market is trending down, blue Fibonacci support behaves the same way. It can create a bounce. The sellers might take profits. The buyers might enter positions, guys. And you see these long before you ever get to them. We're also going to look at yellow 1-to-1s. And these are going to act as resistance or support. And we've also got a mid-band. So I'm going to encourage you, if you're relatively new, learn these lines and call them whatever you want, but know what they look like. Because these are the places where decisions are being made. These are the lines that may act as termination conditions, and these are the lines that can really ruin your good time. And it's not a hard recipe to understand whether or not you've reached an area that may stop the market, guys. The first thing that happens always is price reaches the area. Trading book, I don't know why you want to change it. I'm not sure how. You could get with tech on that. But did you notice trading book? Pink 1-to-1s didn't make the list. Pink 1-to-1s aren't even on the list of areas that we use for termination conditions. It didn't. Whoever was pushing the market the other direction stopped you out. Didn't even make the list. But Jason would be able to help you with that. I'm not sure how to change the colors on them. I try to avoid that stuff. I leave my software stock because I'm afraid I'm going to break something. So guys, if decisions are made at key areas, and I like that phrase, right? It lets me know that I'm not in charge. If decisions are made at key areas, then price has to reach that area for decisions to be made. So If the buyers are in control, if the market's trending up and it reaches Fibonacci resistance, if it reaches one of those magenta divergence highs, if it reaches yellow 1-to-1s, the only thing you have to do is ask yourself, where are my triggers? That's it. If your triggers remain below resistance, you've reached an area that may stop the market. You've reached a termination condition. This is an area that may create an untradeable bounce. This is an area that may reverse the market completely. So when the triggers remain below resistance, no trades into that area. Rule number 2 is not met. You no longer have a clear path. When the market trends down and it reaches Fibonacci support, or maybe it's one of those light blue divergence lows, maybe it's yellow 1-to-1s, but when price reaches that area, it sets off the decision-making process. If your trigger lines remain above that area of support, no more short trades into that area. This is an area that may stop the market. This is what we call a termination condition, guys. And this is the most basic way to do it. If price reaches Fibonacci resistance, how's that for pretty spectacular? And the triggers remain below, this is an area that may stop the market. And sure enough, it cratered right off of it. Support holds. And you're going to see this if you scroll back, coming from support, off of resistance, support again. And guys, they do break with momentum, but if you're in a long position, what a great place to take profits. If you're thinking about that next trade, what a great giant waving red flag saying, hey man, don't do it. Wait a second, let's see what the decision is. Let's see what the reaction is, rather than just hoping that an area breaks. Notice that the market pushed down here and none of the triggers broke through that area of support. And sure enough, the market didn't continue down. Guys, this is rule number 2 in effect. So learn this. Learn to respect these lines. Scroll back on your chart and take pictures of these lines stopping the market. Like I said on Monday in that crazy volatility, 123 instances where key Fibonacci areas stopped the market, created an untradeable bounce. 123 times Nexgen users didn't have to lose money. Kind of cool, I think. So when is it broken? If we can't trade into it, well, we have to either let it reverse the market or it's going to break, guys, and they break all the time. They typically break with momentum. Rule number 1, that separation between the small and large. This is what it takes to break an area more often than not. And an area is considered broken when both the small triggers, both lines of the small triggers, and the large triggers, both lines of the large triggers, if they get south of support, support behaves as resistance, guys. And if they get north of resistance, resistance behaves as support. It's the exact same key number. It's just changed its roles once the triggers get to the other side. So if you're brand new, there's really 2 options. You either have a clear path or you don't. You either have rule number 2 met, and guys, this path will remain clear until price reaches the next area, and then the process starts over. So almost every time you reach a line, it's a termination condition, at least in the moment. You have to be patient, guys. And the easiest trades are coming from areas, not into areas. So is everybody okay with that? Price reaches an area. If the triggers remain below resistance, above support, sit on your hands for a second. Do nothing. 90% of your day is spent reading indicators. 90% of your day is waiting for these advantages. And then if the triggers get to the other side, let's look for momentum. Let's look for a pullback on that small chart. Let's find an opportunity to make a little money. So guys, those are your options. It's either broken or it's not. Brand new users, keep it simple. And it's going to take you to what it looks like when these areas have the potential to break, guys. This is what we call a 50-50 look. And everybody associates a 50-50 with, it might win, it might not, right? It's a coin toss. Guys, that's not at all what it is. 50-50 is nothing more than a reference to where the trigger lines are. 50% of your trigger lines, the small triggers, have broken through the area of support that was just a termination condition. 50% of your trigger lines have remained above. And we know that both must be below for the area to be broken. So guys, when you have this look with odds favorable momentum, what you're looking at is the potential to break. Areas break all the time. This look right here, this is what we call a 50-50 look. You could call this a one below, one above look, or you could call it a straddle look. You could call it a potential to break look, whatever suits your brain. But what it means is that this area, because of all that momentum, that OFM, has the potential to break. But it will never, ever, ever be a clear path until both small and large get to the other side, which means that it will never be rule number 2 met. It will never be rule number 2 met, which means that it can't be a high probability trade, which means that you've just been introduced to the second trade that you're going to learn once you understand these very basic concepts. You will be able to capitalize on these 50-50 looks, and I'm going to give you a plan to give you the best chance of success with them. But you have to go into this trade understanding that these areas do in fact have the potential to hold, that they're not broken, and you will see that they don't always break. Sometimes they go back to it, but very often you'll see these 50-50 looks. And guys, fights happen at fibs. So they don't always make it through. Let's see if we can find another one. There's one of those 50-50 looks. The market had the potential to break, and it didn't. So there's a very key way to take these, guys. And this will probably be the trade you take more than any other trade, which means that you have to be great at momentum. And you really have to understand that this is only potential, that it's not a sure deal. And guys, those are termination conditions on a large chart. Large chart lines can stop the market. But the large chart is a slow chart, guys. This large chart is a very broad stroke of a brush, and it's hard to see change on a large chart. So there is one termination condition. Only one. There is one termination condition on a smaller chart, on a faster chart, that'll help me see the change that I can't see on that large, slow chart, guys. And it's 3 divergences, 3 losses of momentum. If it happens in the same price range, this may terminate the trend, guys. It may create an untradeable bounce. It might reverse the market completely. But if I see 3 light blue cyan lines from a low or 3 magenta pink lines from a high, it tells me that rule number 2 is not met. It lets me know that I don't have a clear path. And what it means is that I just have to sit on my hands for a minute because the market may bounce, the market may push. So 3 divergences can stop the market. 3 divergences with weak anything can happen triggers is even more powerful. And 3 divergences when that final pivot is higher than the previous from a low or lower than the previous from a high creates a little head and shoulders pattern. And that makes it more powerful still, guys. And I wanted to do this. I took this picture this morning. The large chart, yeah, this morning on the S&P, guys, it was coming from this awesome Fibonacci resistance held the market. It's screaming down. Life is good. And everybody's thinking, I can't wait to go short. Look at all this. And then 1, 2, 3 divergences in the same price range. And this is the textbook look. Little head and shoulders, 3 divergences. Guys, this is where the market shot up from. And even though the large chart still says down, the small chart said, hey, don't do it. Don't try that last short trade. It's not going to work. And guys, it did not work. So this is the only time on a smaller, faster chart where I'm going to let rule number 2 not be met. But you'll recognize this when the rules are met on a large chart. You go look for that entry, and suddenly it's not the perfect scenario. So that's termination conditions, guys. And termination conditions are probably going to be one of the biggest reasons you don't enter the market as a brand new user. Termination conditions are the things that are going to force you to be patient. Termination conditions are going to frustrate you because you're going to feel like there's a million of them if you haven't taken a trade in 2 or 3 minutes. And 90% of your day, guys, it's just reading indicators. 90% of your day is waiting for a pattern to develop that has been proven to win more than it loses. And what you'll find is that rule number 2 will keep you out of a tremendous amount of losers. Rule number 2 will keep you from donating your money to the market when there's no reason to be donating it. And it'll help you identify consolidating markets. That's one of the things experienced traders that come to Nexgen tell me is one of their most difficult situations to be successful in is consolidation, is what they call chop. Rule number 2 typically helps you identify that, whether it's divergences on a small chart or key areas on a large chart. And guys, the difference between the successful traders and the unsuccessful traders, in my experience, isn't being able to be this master reader that takes advantage of every move in the market. Because guys, there's billions of dollars traded every day in the futures markets. It's their ability to do absolutely nothing. Their conviction to adherence to rules. Their belief that if they don't have a statistical advantage, there's absolutely no reason for them to pull the trigger. And that's what separates the successful from the struggling, in my experience, is your ability to do absolutely nothing. And guys, sometimes there's nothing to do. If I don't have momentum, a clear path in an entry area, there's nothing for me to do. But if I have momentum and a clear path, you better believe I'm going to turn my attention to that smaller, faster chart, and I'm going to pinpoint where that small crowd is most likely to fail, guys. And I'm going to do it with such precision that I'm going to use a limit order. I'll literally wait for the market to come to me. And I'll use a limit order at an area, at a fib, at a mid-band, at a yellow 1-to-1, any of the three. And I'm going to tuck that area inside what we call favorable large triggers, guys. So when I say it in one breath, I'm going to use a limit order to buy or sell a pullback, which is that little fight that the small crowd creates, at an area, fib, mid-band, yellow 1-to-1, inside of favorable large triggers, guys. And this is where I pinpoint exactly where the market is most likely to continue. This is where my risk becomes the absolute least. This is where my chances of success become the absolute greatest, guys. And it's that refinement process. One bar on the large chart, this will never change during your trade. You'll always have that odds favorable. And you'll have the same path that you had when you got in. And inside of this one bar are all of these bars on a small chart, guys. It's like an X-ray. When the rules are met, if you go back historically, you're going to see these tails on a large chart. We don't trade tails, guys. We don't take entries on the large chart. The very top of this tail, more often than not, is a pullback to resistance inside of favorable large triggers. And you're going to pinpoint exactly where the top of this tail is most likely to form. But you're going to do it on a small chart. You're going to let the small crowd fight. You're going to pinpoint an entry. It's going to reduce your risk. And guys, you have the potential to be $200 into your trade before the next bar even forms on a large chart. And it's pretty outstanding. But the one thing that you have to know, to be able to catch entries, to be able to identify the best of the best spot, guys, there's a phenomenon that happens on every chart. And it's large triggers. They're like magnets to price. And price returns to the large triggers. And it's pretty simple. It corrects, if you will. Triggers are a moving average. Price goes away from the moving average. It corrects to the moving average. It's a mathematical something that I don't understand. But what I do know without hesitation is that price returns to the large triggers, whether it be the large chart or the small chart, if it's a range chart, a month chart, a day chart, guys. This happens on every chart. But we're only using 2 charts. So Nexgen has taken the large triggers from the large chart and has superimposed them onto the small chart, and we call them synthetic triggers. That's what those step triggers are, that look like a second set of large triggers, guys. And when the large triggers, the smooth ones, and the synthetic triggers, the stepped ones, when they are one on top of the other, when they are like 2 snakes riding piggyback, this takes 2 correction points. This takes the correction point from the large chart and the correction point from the small chart, and it turns it into only 1 point. And then it's going to be inside of these triggers where you're going to look for fibs, mid-bands, and yellow 1-to-1s. And that is where the high probability trend trade originates, guys. It originates from areas inside of what we call favorable large triggers. And the further apart these triggers become, then the wider the correction point becomes, and the less precision and the more risk you're going to find on these trades. So initially, brand new users, remember, this class is dedicated to giving you the best of the best, the highest probability. Favorable large triggers is your highest probability entry. So how do we define where the market is most likely to continue? I'm so glad you asked. When the large chart's going up, when the large chart has odds favorable momentum, when the large chart has no termination conditions, guys, I keep talking about the rules have to be met over and over and over again. We're going to wait for the small crowd to do their thing. We're going to wait for what's called a reversal bar. And a reversal bar is nothing more than the first red bar after all of these green bars. It's reversing. And then a reversal bar is nothing more than this first green bar after all of these red bars. So when the market is trending up, it's got momentum, nothing in the way. We're actually going to wait for it to look like it's coming down. And this reversal bar is going to set off the process of defining where the market is most likely to continue. So at the time of the reversal bar, the first thing I'll do is I'll find my trigger lines, large and synthetic, and I'll make sure that they're overlapping, that they're one on top of the other, two snakes riding piggyback. And then once I've defined and found those favorable large triggers, I'm going to look inside of them. And guys, I'm looking for fibs, I'm looking for a mid band, and I'm looking for yellow 1-to-1s. Sometimes I'll have all three, sometimes I'll only have one. But my window of opportunity, guys, the point where the market is most likely to continue, the point where the small crowd is most likely to fail, the point on this small chart most likely to give me a bounce in the direction of the overall trend will extend from the highest point of support to the lowest point of support inside of favorable large triggers. And I want you to start embracing that language, and especially that word, inside of favorable large triggers. So guys, this is a window. This is a window of opportunity, and the market may bounce off the top and it may bounce off the bottom. But because of the momentum and the clear path, you will activate a limit order at the top of that window, at the point, the support inside of favorable large triggers closest to price, because we don't really expect the small crowd to pull it off. We're not rooting for them. This is exactly where they're most likely to fail. This is where you guys will enter the market. If the small crowd can push down to that second level, that's okay. We're still in a rules-based trade. We're still where the market is most likely to continue. It's a little bit of a window. But any line beyond those triggers, any line beyond those correction points is outside of the window of opportunity. It's outside of the point where we expect the small crowd to go. And guys, we don't want to be in a trade all the way down here. If those 1-to-1s can't stop it, if those triggers aren't the actual correction point, we're not going to hold on to that thing for dear life. And the same is true going the other way, guys. First, the rules are met on the large chart. Odds favorable momentum, clear path. I'm going to wait for the reversal bar. The reversal bar is not my entry, guys. The reversal bar is on the wrong side of triggers. This is a loss of momentum. And this reversal bar has me looking for my favorable large triggers, and then once I find them, it takes a half a second, I'm going to find the lines inside. I'm looking for fibs, mid bands, and yellow 1-to-1s, and sometimes there's this magical moment where there's only one line inside, guys. You have one line inside of these favorable large triggers where the market is most likely to continue. And this one line, 2 or 3 ticks below it, guys, I'm going to activate a limit order, and I'm going to hope that the small crowd has it in them to get to me. This becomes my entry for the highest probability trend trade. All of these lines, I've got 2, 3 levels of Fibonacci resistance as well as 1-to-1s. They're beyond the trigger lines. They're beyond the correction point. I don't want to wait for the market up here. I don't want the market to get up there. My ability to identify exactly where the market is most likely to continue gives me the understanding of where the market shouldn't go. And guys, this is the first part of management for you guys. Great entries are the first part of management. They create manageable trades. But if the market shouldn't go beyond that correction point, if the market shouldn't go beyond that window of opportunity, this is where your first stop is going to go, guys. Your initial stop will be 4 to 5 ticks beyond the large triggers, beyond the synthetic triggers. So if these are splayed out all over the place and there's a huge gap between the two, guys, your stop's going to be huge. But when they're one on top of the other super tight, you're pretty close in there, guys. And if the small crowd doesn't fail, if this is one of the 20 to 30% where they can push past that point, you're waiting right there. You're going to say, you know what? They can come get me. I'm out of this trade. I'll wait for the next one. And you will be skilled enough to find the next trade. But the great thing is, if you have odds favorable momentum, if you have a clear path, if you take the best of the best entry, more often than not, you're going to get a reversal bar in the direction of your trade. And if you get a reversal bar in the direction of your trade, you can reduce risk even further. A couple ticks above it, a couple ticks below it, guys. And it's not uncommon or unusual to see you guys pick off the most beautiful entries ever, to have all those advantages in place, to get that reversal bar confirming the movement in the direction of the trend, only to have it fail. But rather than giving away $200 or $300 into this trade, you find yourself down 40 or 50 because you had great management, because you pinpointed exactly where the market was most likely to continue. So guys, I encourage everybody in this room, for your first 20 to 30 days with Nexgen, focus on entries. Everything's going to fall into place, but focus on entries. Focus on getting into the market where the market is most likely to continue. And one of the easiest ways to do that isn't to take trades, much to the dismay of my students. One of the easiest ways to create recognition through repetition, guys, is to scroll back historically, to open up your large chart and to go back and to say, hey, look at this. There is momentum and my path is clear. Let me circle one of those tails and see if there was an opportunity on a smaller, faster chart. And we'll look at it. We'll see if there was. And here, smalls are starting to break, potential to break that divergence high. Let me circle one of these tails and let me come back to my smaller, faster chart. Where's my smaller, faster chart? And let me see what that circle looks like. And that circle looks like, come on, baby. Well, it looks like a pullback directly to support inside of favorable large triggers. Guys, I can't make this up. This is the S&P right now. That was 20 minutes ago. This one was a little bit on the wrong side of the correction point. That might not have been your trade. But guys, this one was odds favorable. The path was clear. Only 2 divergences, not a deal breaker. And it pulled directly back to support inside of favorable large triggers. And some of you will notice that it didn't get you here. And if you chase the market, it still came back for you, guys. This is your pattern right here. Can you guys give me a Y in the room? Not if you understand it like it's second nature, but if you see the correlation between the two charts, if you see that if I take a picture, I can start writing down my rules. I can say odds favorable momentum, and I can point to that look that I've studied over and over. And I can go to the top of the bar, and I can use the language, right? Price did not reach an area. My path is clear. And then once again, guys, language pays dividends. Bought a pullback, add an area, and then go all caps inside of favorable large triggers. And ladies and gentlemen, this is your best of the best look. Take that look, go to your spreadsheet, go to your favorite looks, and drop it in there. Because what you're doing is you're building a trading plan right now. You're building a plan that suits your needs. Perfect high probability trend trade long. And as you go through this process, guys, there's like 400 of them here that you can look at. And that's kind of what this is. You can go back and study this every day. You have 10 days worth of data on every workspace in your NinjaTrader section. You could go back and find 50 high probability trend trades and never have to take a trade. You could commit the look to memory and never have to take a trade. Never have the pressure of making money or losing money. Simply creating recognition. And then you can go through the spreadsheet. These are right from the spreadsheet. And you can begin to commit this look. Guys, this is always momentum. And that's always a clear path. And look at that entry. It looks almost exactly like the one that we just showed. And the great thing about futures, when everybody Monday was scared about their 401ks, when their mutual funds or whatever you call them, where they take a whole bunch of everything, and if it goes down, you get heartburn. Guys, our clients were making money short. And it's not uncommon to have a day where you make money when the market goes up and the market goes down, but you have to know your rules to do it. You have to be able to put it all together and to find that high probability trend trade entry. And once you can do this very simple thing and recognize these advantages, guys, what happens is you'll begin to see more opportunity. You'll begin to see more and more instances where you can capitalize. So everything begins. Whoops, that's on the wrong screen. Everything begins with learning to read your charts. Everything begins with being able to recognize those three advantages. So the easiest way to do it, and I'm going to go soapboxy for just a second. People ignore this, and I can't for the life of me figure out why the hell you don't want to get good at this fast. To really get good at this, learn what each rule looks like when it's met, guys. Take 25 pictures of strong triggers and of weak triggers. Know what it looks like on both sides of the coin. Take 25 pictures of a clear path. Take 25 pictures of termination conditions. Know what it looks like when it's time to trade and when it's not time to trade. Take pictures of that 50-50 look so you never convince yourself that the path is clear when it isn't. And don't just take pictures, guys. Talk about the whys. Talk about why it's strong triggers. What do those strong triggers mean to you? What rule do those strong triggers correspond to? And what's going to happen is you're going to create this database mentally and physically. And you'll never make the mistake about strong triggers because this look is the exact same look that we've seen 50 times today. And the more times you take the picture, the more times you talk about the whys, the easier it becomes to catch in the moment. The less likely you are to get caught with those weaker triggers without the momentum to push you in the direction. And guys, I've done a tremendous amount of work to start this. So you need to put your 25 pictures in. And it's going to be your 25 pictures that turn you into a chart reader. So I'm going to give you this one, guys, and this is the one of the fastest ways to get to where you want to be. I'm also going to give you a high probability trend trade checklist. And this checklist is designed to, one, give you something to print out to put on your desktop to make sure that you're always following these rules, to make sure that you're insisting on these advantages. And guys, I've never had anybody, no, trade away, practice. So trading book, I'm not saying don't trade. Simulate, practice these things. But practice entries, right? Practice recognition, practice, and don't worry about the money. One of the things that happens, and guys, I know you paid great money for the software and it's worth every penny. And everybody believes that they need to recoup their investment within the first week. And it's just not the case, guys. We're setting up for long-term success. So in the beginning, focus on being able to enter where the market is most likely to continue. Focus on being able to recognize these advantages. Focus on piecing them together. And what you're doing, Trading Book, is you're focusing on the process, which means that you've got to simulate. You've got to practice the process, right? So you're going to go back and you're going to take pictures, maybe when the market is closed, you're having a cold beer, a little bit of popcorn, cats in your lap, and then you're going to come in the morning and you're going to practice what you learned yesterday. And you're going to try to execute these high probability trend trades. And this first page gives you a checklist to follow as you look for them. And the second page shows you exactly what it looks like to have rules 1, 2, and 3 met, guys. So as you go back and take pictures, you've got a little bit of a cheat sheet to make sure that you're taking pictures correctly. So the idea Trading Book is that the two work together. That not only do you study, but you practice, right? Not only do you sit in the classroom and learn about what's going on, but you also get into the thick of things and you practice. You go to the batting cages, you go to the driving range. So recognition is what's going to set you up, guys. So print this first one out. And I've never had anybody use this checklist truthfully and do worse than 70%. So this kind of goes back to the idea that you're getting a plan that you can be successful with as you learn to read these indicators. And then the plan to keep you focused. And guys, I'm going to say this. This plan is designed as a stepping stone. This is your first trade, not your last trade, not your only trade. But this high probability trend trade, as it's taught, it optimizes your chances of success. So, trading book, this starts to create that confidence because this really is a trade that wins more than it loses. This is a trade that revolves around getting you to speak to yourself in terms of advantages. In this very simple approach, guys, this gives you a trading plan that you can be profitable with while you continue your education, while you become a better chart reader. And it's going to be through simulation, study, class feedback, and continuous practice. This is how you're going to get to where you want to be, guys. And then you're going to create a plan that suits your needs based on your ability reading your indicators. This is not the end of the road for anybody. It's never been designed to be the only trade that anyone ever takes, guys. In fact, most of your days you might catch 2 or 3 of these, possibly. But it's going to be your ability to read your indicators that opens the door for the other trades. So your simple plan for consistency, guys. First of all, don't fight the large chart. The most broken rule is trading in determination conditions. And it's crazy because that's probably the one rule that I spend the most time on, reminding you that these can stop the market. The easiest way to commit financial suicide, and I love this. My brother wrote this book. He's an author. Chapter 1, your warning signs your friends are in trouble, guys. They're trading against strong triggers. If you're ever fighting the momentum on the large chart, you're doing yourself a disservice. We talked about this yesterday with a trade that really takes advantages. No, it's not trading book. It's just a picture. It's very tongue-in-cheek. But yesterday we talked about, guys, there's going to be opportunities to get in at the bottom, to get in at the top. But one of the things, and one of my steadfast rules in my own personal trading, is never fight those triggers. Never fight those triggers. So even if every rule's met, but the triggers are strong, I won't go against them. It's too much momentum. And then the second thing, warning signs your friends aren't paying attention, is they trade into those termination conditions, guys. Seek help immediately. And it's very tongue-in-cheek. And then Ron said it, and guys, I'm telling you, he says it every day that we talk about this. The high probability trend trade is designed to teach chart reading. And then when it becomes easy, the other trades will become obvious. Thank you for that, Ron. But guys, it's true. Give yourself a little grace. You're brand new. So define your entry, right? All we've talked about is how to get into the market. All we've talked about is how to recognize these advantages, to take that best of the best entry. And the other side of the t-shirt that says, let the large chart lead the way, the back of the shirt, Christine, needs to say, great entries create manageable trades. Great entries put you in the position to have the least amount of risk and the highest profitability potential, guys. So once you take your entry, once you find that best of the best, once you're in the market, you're going to have to do something with it. And guys, management is where most of you are going to pucker up and just seize. You're going to let the adrenaline, the fear take over. So the way your entries are mechanical, the way your entries are nothing more than a set of rules that have to be met in order to pull the trigger, guys, your management can be just as mechanical in the beginning. And there's a million ways to manage a trade. And here we go. Once again, you will craft a plan tailored to your personal goals based on your experience reading the indicators, guys. But management is a reflection of your ability to read the charts. So get good at chart reading. And in the beginning, your management can be very, very basic. And your management is going to revolve around the idea that you entered the market because the large chart said down, because the large chart had odds favorable, because the large chart had a clear path, and you took an entry at the lowest point of resistance inside of favorable large triggers, and you did everything great. And you know, you manage risk long before you ever manage profits when you're day trading, guys, and you manage risk through advantages, and you manage risk through great entries. And then once you're in, you've got two choices. Your stop goes where the market shouldn't. Your stop goes beyond that window of opportunity, 4 or 5 ticks outside of those triggers. And I know this picture is a little faulty. I'll fix it. But your management plan is it all begins with your great entry, guys. And you're either going to get stopped out. And I'll tell you right now, You will get stopped out. You will take losers. Anything that wins 70 to 80% of the time has to lose 20 to 30% of the time. But force them to come get you. Don't tighten up because you're afraid to lose money. If you're afraid to lose money, you don't need to be day trading. You will lose it, but you'll also make it. Make them come get you where the market shouldn't go. But more often than not, rather than hitting your stop, you're going to get that reversal bar, that confirmation bar. And this is your first stop movement. And it's not because you're scared or because you think you saw a trigger line do something. If you get a reversal bar, then your new stop is 2 ticks above it. That's it. And then there's nothing to do. Once again, either your stop gets hit or the market goes to your first target. And the same way, because of all those advantages, you are more likely to get a reversal bar. Guys, you're more likely to hit that first target. And the first target for my KISS users is only $100 in the distance. And a lot of you are saying, but Mark, I can't make any money on $100. Mark, nobody ever got rich only making $100. Guys, this is one trade. This is one moment in time. And that $100 comes to you in a matter of seconds more often than not. And you know that if you only made $100 a day with your day trading, that's an extra $25,000 a year. So get paid. That's the goal. Get paid. Get money in the account. Let those sweaty palms dry up. Let those butterflies fly south, right? And now you're paid, and you're going to move your stop to break even. And you're going to have zero risk on the trade, guys. None. And the whole idea of going break even isn't that break even is the best spot, but break even makes it easier for you to hold for the second target. Break even takes all the pressure off because you've got nothing to lose. And break even makes it easier for you to trust the idea that it was those strong triggers, that it was that clear path of why you got in the trade in the first place. So you're either going to get stopped out break even, or they're going to go to your second target. And the second target in the KISS plan, the KISS plan management, has your second target at only $200 away from your entry. Which means that if this highest probability trend trade that typically wins 70 to 80% of the time goes the distance, you just made $300 on this trade. $300 on one trade. And you did it without emotion and fear. You kept everything very mechanical. But what you were doing is you were teaching yourself to recognize advantages, and you were teaching yourself how to pinpoint where the market was most likely to continue. And you're teaching yourself to trust that the large chart will get you to that next target. And then guys, you're going to create a management plan outside of this. There will be other exit conditions, but the best part is you're going to start to see that when the market is screaming down and there's absolutely nothing in the way, you're going to be able to hold for bigger moves. You're going to be able to turn that $300 trade into a $400, $500, $600, $700 trade. And you're going to do it not because you hope to make more money, but rather because your indicators, your chart read told you that the market was likely to continue to that next key Fibonacci area. And you'll do it because it's based on reason and chart read rather than emotion and fear, guys. And that's what we do every day. And then I'm going to share one more with you here. So that was your KISS plan. And then the KISS plan gives you a 50-50 plan as well, a potential to break plan when the path isn't clear. And it relies on your ability to understand momentum, and it relies on your ability to understand terminations, and it relies on your ability to recognize divergence and to read your charts in the moment, guys. And this will probably be the trade that you take more often than not, but I've given you the best of the best way to take it. Yeah, please. Man, I love input, trading books. I love input. I like to share this with you guys as well. Daily goals. You should always have a daily goal. You should know what it is that you're looking to get into. And guys, these daily goals are just that. They're daily goals. They are what you're trying to make every day. And this kind of puts it out. You don't have to make all the money to make a lot of money, guys. $200 a day is 50 grand a year. $400 a day is 6 figures. $600 a day is $151,000. That's only $300 per contract. And guys, it's very doable. It really is. It's a very, very doable process. So I'm going to give you right now, I'm going to give you Chart Reading 101. I'm going to give you this daily goals sheet. I'm going to give you the KISS plan. I'm going to give you the high probability trend trade checklist. I'm even giving you in PDF form, the PowerPoint that I use to teach the room every day. And I'm also going to give you the spreadsheet with all of my stuff in it, which means that you now have everything that you need to be successful with this software. You have everything that you need to become a chart reader. The only thing that I haven't given you guys this morning, the only thing that I can't give you is experience. I can't make you study. I can't make you participate. I can't give you repetitions. So that's where you're going to have to come in, and you're going to have to participate, and you're going to have to take pictures, and you're going to have to annotate charts, and you're going to have to commit these looks to memory so that they become easy. But if you do that, then welcome to Nexgen. You've got the golden goose. Don't turn it into fried chicken. One of my favorite phrases. Are there any questions about the high probability trend trade? Are there any questions about the three concepts? All right, I'm going to read yours out loud, Trading Book. Your confession is you read all education materials on the Nexgen page and on class only focus on high probability trend trade made you confused, was taking momentum trades, focus on strong top or bottom. Your suggestion is to have one sections for beginners, 101 traders, so that you can divide the learning process into section kind of college or school, maybe an advanced section. So I'm going to address that two ways because I don't disagree with you at all. I don't disagree with you at all. But Trading Book, you went to college, right? And they always gave you a syllabus. And they said, hey, this is what we're going to do throughout the whole semester. And if you started reading the later chapters before the first chapters, if you started getting ahead of the syllabus without the foundation, so just to give you an idea, and maybe we need to do a better job of pointing this out. So I'm actually going to take this and I'm going to go talk to my salespeople as well. If you go to the trading guide, it starts with a glossary of common terms, and then it goes to rule number 1. And then it goes to rule number 2, and then it goes to rule number 3. And it's in chronological order, the same way I teach it. So you could come here and find out all about these trigger lines, right? And there's a lot of pictures in here. Or you can be very, very focused on what I teach in the room. And I think that, I think you're absolutely right. And I think that you're a go-getter. And I think most people are. And when they tell you, hey, go to the website, right? Go to the website, start watching videos. I think you confuse the ever-loving shit out of yourself. And I think there's a ton of information. And I believe, and this is just me, and I believe that it's like drinking from a fire hose. I believe it's like taking too much in. You can't process it all. But Trading Book, have you noticed that every morning when I start this classroom, I tell you, let's focus on only 3 rules. And every morning for the first hour, I said, let's keep those 3 rules on only 2 charts. And every day, I say, let's focus on nothing more than entries for these 3 rules. And let me give you everything that you need to be successful with the software. Have you heard that at all? Anybody? Does that sound familiar? The challenge is I can't stop you from going extracurricular. I can't stop you from being aggressively wonderful and trying to learn everything in the first day. But I promise you, I do everything I can to keep you guys harnessed into the most basic every day. And I even wrote this to help out with it. And I'll drop that in the room. Why not? Why not make it easy? And then, so check it out. just because I love that you're asking. There's even a section trading book that says first 30 days and beyond, consistent winning trade. And guess what it is? It's that damn high probability trend trade. So we do it, and we really do present like this. And I present like this every day. Every day I say that the fastest way to get to where you want to be is to participate. Every day I say that you need to use a spreadsheet. Every day I only talk about 3 rules, and you'll notice that I don't throw all those other trades in. The only time we talk about any trades outside of a high probability trend trade is if you guys present it in class, because this is an educational room. But the first hour is 101. In Trading Book, there used to be a class that was only 101. And that's it. And I love that you listen to him. So what that means, Trading Book, is that you and I are married, and you're going to have to put a ring on my finger, because I said it every day and you didn't believe me. And then once Ron said it, you're like, oh, okay. And if you're married, you're laughing right now, because that's exactly how it is. So, man, thank you for that. Because this is something that I'll take to John Novak, and this is something that I'll take to the salespeople. And my goal has always been to confuse you guys as little as possible. So Trading Book, let me show you how that works. And guys, this is great. This is what makes the class awesome. I say that all the time. So I'm going to scroll down and I'm going to go to the HVA trade, the momentum trade. Watch this. The first rule says a good top or bottom, which means that you have to have a termination. So your understanding of a top and a bottom trading book comes from your understanding of a termination that is presented in rule number 1 or rule number 2 of the high probability trend trade. And then it says don't trade into a termination condition. Once again, the lesson from the high probability trend trade. And then it says define your entry, which is exactly what we do initially at areas inside of favorable large triggers, but you're defining your entry just at a different spot. But you're still using the first 2 rules. And then when you go to the momentum trade, tops and bottoms, no terminations, a different entry, revolving around momentum and stuff like that. So your high probability trend trade takes you to that next level. And if you get great at the high probability trend trade, what happens just by default is that you become a chart reader. And chart reading is 90% of the day. You won't need me to teach them. Trading Book, you won't need me to teach the other trades after you learn the high probability trend trade. You'll be able to look at the rules and you'll be able to say, holy shit, this makes sense. And then as you practice them the same way that you practice the high probability trend trade, you'll present them in class and you'll get feedback and we'll talk about everything and I'll help you through them. But what you'll find is that you don't need me as much once you can read the charts, because you will understand where the market is likely to continue, where it's likely to go, and where it's likely to stop. And you're developing that recognition through the most basic form. This is your foundation. This is 300 feet of concrete that you're about to build your trading skyscraper on. And if you try to get ahead of it, you're going to confuse yourself. That's why we do the KISS plan. That's why I talk about these the way that I do it. And here you go. You're learning to read your indicators. And until you can, this gives you a plan that can make you profitable while you're learning the basics. This gives you a plan that's very focused. So thank you for that. Unfortunately, I can't keep you guys from wanting to know everything. But this first hour, if you've ever noticed, it's remedial and it's the first hour every day. And this is the only thing. If you go back and watch 100 days worth of videos, the second and third hours are so different from one another because they all rely on you guys posting in the room. And then that's the second half of a Trading Book, is I give you the foundation and then it's your job to practice it. So when you practice it, you start throwing your pictures in the room and you talk about those rules: momentum, clear path, entry area. You tell me what you see. You begin to associate the language with the rules. And this is how we refine your ability to read your charts. is you tell me what your chart read is. And that's what we're about to do in the second hour. We're about to get into that, where we start looking at it. If I made a guide or a handout at the top of the Nexgen page, do you know what would happen, Trading Book? And this is a true story. Do you know what would happen? Is I give you everything that would be in that guide. Do you agree? I give you everything that would be in that guide at the top of the page. But I don't give it to you all at once because that's freaking overwhelming. So before I give you Chart Reading 101, we go through some Chart Reading 101, right? We've tried that, but nobody ever listened. Nobody ever listened. We've done it. We've done outlines that say exactly what you should do. We have put this in the order that you should learn them. We told you what you should focus on for your first 30 days. I mean, we did everything that you just said that we should do. And God bless you, you guys don't listen. And that's okay because you're excited. And that's why I teach the class the way I teach it, is because what I try to do is harness your excitement a little bit and keep you focused. You have everything that you need right here. So, Trading Book, do you remember your first day in the class with me? So, I told you exactly what you just told me, that I should write it in bold and read HPT and focus on it only for 30 days, right? I said that. I said it loud. I broke it down into individual pictures. I showed you how to study. I did all of that. Are you telling me that if I put it up here in bold letters, that you would adhere to it 100% rather than hearing it from me here in the classroom? That typing on the page would be better? Let's see. There's how to get your demo. There's how to get the Discord. Here's the logic. Maybe this is what needs to be. This just talks about kind of what's gonna happen. Indicator over. Okay, I'm going to go through this one with John. Let's see what the comprehensive guide is. Chart reading, trade reading. Oh, look at that. And it starts with triggers. And it goes, yeah, this is too much. I'll talk to John. And man, I appreciate the feedback because I don't think you're alone on this at all. And if you read it before you come here, then you don't know what a high probability trend trade is anyway until you get stuck with me for a day. You don't have any idea what that means. You don't have any idea what momentum means or what it means to have a termination condition. And I get it, and I don't think there's a perfect way. No, you're not alone on this at all. So what we'll do is I'll bring that in and we'll have a discussion today. Maybe not today because, you know, they all ignore me because I'm just the education guy. Oil news in 3. And guys, I lost Ninja Trader, so I'm going to reload that. While this is reloading, while my indicators are coming back, I'm going to take 5 minutes and I'm going to go stretch my legs and breathe deep and do all those things. Go do the same. Thank you. Jerry, it has. And Morgan, I'm glad Ron gave you that answer. I never stop learning. I learn every day. And guys, thank you for sharing your road on this. You guys that have some experience, Ollie, Ron, Jerry, everybody's going to do it different. And everybody's going to have different challenges, and everybody's going to have different strengths, and everybody's going to have different weaknesses. And there is no one path. There is no one way to get it done. And it's repetition is all it is, guys. Repetition is the best of the best. Doing the same thing like Ollie said. Just do it and take notes and annotate and ask questions. And too much knowledge at once is definitely difficult to manage. So, guys, I'm going to bring crude oil back up. While this is loading up, I'm going to go take a break. I'll see you guys in about 5 minutes. one of the things that I didn't do is I didn't connect to my account. So that's why that didn't load up. We're going to get through and we're going to go and we're going to start talking. And guys, one of the things that that is great about this community is you guys are more than welcome to share your experiences. You're more than welcome to talk to each other about what you see. But one thing that you'll notice, and I think everybody will notice this, is that anybody that's been in this room more than a couple months has the exact same message. Focus on the high probability trend trade first. Focus on a trade that teaches you to read your indicators, and then once you do that, it's going to open the doors without a doubt. So I'm going to scroll up to the top, guys, and we're going to start looking at some of the pictures that you guys have posted and see what's going on in the wonderful world of day trading. Joel got us going. He did this last night. He was doing a little playback. Guys, that's what this is. Joel actually goes back historically and says, hey, guess what? I'm going to practice. I'm going to get repetitions. I'm going to do the same thing. Joel has, notice that he said he had odds favorable momentum. He's starting to talk through it. He says, man, no clear path. Traded into a termination condition. And he lost. And what a great lesson. Guys, go through. Take these trades. Take these losers. Be okay with it. Taking losers is a part of learning to win. And that's one of the reasons why simulation does so great for you, because it teaches you to win and it teaches you to accept losses when they're the right losses. Pete took this trade. He goes, so this was a momentum trade. Triggers were up and strong inside of the large triggers. So not odds favorable, but there was a clear path and it was broken and the market is coming from a great bottom. And Pete jumps in, right? And it goes against him instantly. And Pete says, I know this look with the clear path. This market's booming. I'm going to take it up to the fib. And he does. He takes it right up to the fib. And he's in somewhere about right here. Everything is screaming up. And he says, you know what? Lines can create problems. Lines are where decisions are made. And look what happened. Boom, boom. Bounces its head off of it a couple times. But then when he gets to the other side of things and it's still cranking, he gets in. And he gets paid. And he goes, you know what? There's more money in this one. Let me get back in and get paid. And he's taking it off and he's getting paid. And Pete, this is absolutely beautiful. And it got a little funky here for a moment, right? Where you had to manage and you were very active in your management through your chart reading. And then eventually, 2,100 on his first trade. And guys, the thing that I want you to notice with Pete's chart is that it's not a high probability trend trade. It's not a high probability trend trade. It is a chart read that creates an opportunity. And this is the part that I want you guys to really get from all the back and forth that we've had, is it was Pete's ability to read the charts that allowed him to capitalize on this move. And that's the goal, is to turn you into chart readers. So great one, Pete. Freaking amazing. I'd love to start the day every day with $2,000. Big chart leads the way, right? Christine, Pete's going to need one of those t-shirts. Large chart leads the way. What a great way to start the day, Pete. I would already be out swinging golf clubs, but that's just me. All right, Paul. High probability trend trade? I like the question. Triggers rolled. It's momentum. Favorable large triggers with areas. This is where I would disagree, Paul. Your synthetic triggers are still green at the time of your entry. You do have momentum going down, and you're just kind of jumping in, and you're hoping that momentum carries you, and then it doesn't. And guys, there's the challenge of those split triggers. There's the challenge of not trading from areas, right? If you get in up here, at least giving something to bounce off of, you've got room to manage. But when you get in a tick above something that can create a little bit of a bounce, there's just not much room. And man, I know you were like, shit, I didn't get paid all the way up. Somebody better pay me, right? I'm going to be the first one in on the way down. So when you go through and you put the question mark, 2 question marks behind high probability trend trade, all you really have to do is go through the rules. And I like this, and this is a great example. And Paul's got thick skin, and he's an amazing student, so he's not going to bust my chops on this one, right? But one of the things, Paul, is it's not even coming from a key area. Like all that push up, and they don't come. Hey, guys, easy. Both of you guys, easy. I'll separate you. Room's got to be nice. If it's not, I play enforcer, guys. So when we go through and we're saying to ourselves, I love you all, but I'll pull you from the room. The first thing that I have to ask is odds favorable momentum, right? And if my large triggers are still green, I don't have odds favorable momentum. Does that make sense, everybody? If my large triggers are still green, guys, this isn't a gaming room. This is a learn to trade room. If my large triggers are still green, I can't have odds favorable momentum. Is everybody okay with that? If I don't have areas inside of triggers, there's no way this could ever be a high probability trend trade. It just doesn't fit the rules. Does that make sense? And guys, this is why we keep it very, very focused and basic in the beginning, because you'll get to the point to where you never ask yourself, is this a high probability trend trade? Because your understanding of the very basic rules will have you saying, well, crap, I've got 2 of them that are missing, therefore this can't be high probability. But these are the ones that you got to post in the room, right? These are the ones that you have to post in the room, and we have the conversation, and you begin to recognize and you begin to realize and maybe even trust a little bit that your ability to speak to yourself in terms of the rules, of the advantages, is what's going to set you up to take these trades. And I never like to see you guys taking losers. It doesn't make me happy, but I like it when you lose trades that don't fit the rules, because that develops trust in the rules as well. Miss Adriana, everything says down. The market is absolutely screaming. And there's those split triggers. And you wait for it to close the gap back to the triggers. Right up here about 79 with everything going down. And then third divergence takes you out. Absolutely beautiful, Adriana. Nicely done. And then Paul, the exact same trade. I love it. When the triggers are split, there's 2 places it could correct to. Paul let it go to the upper correction. Third divergence takes him out as well. Nicely done, both of you. The exact same trade from 2 different time zones. Oh, there it is again. Getting in on the way down, letting it close the gap to the second correction point. And then divergence takes you out, and you get back in with divergence. Pete, you gotta, there's a lot of decaffeinated brands that are just as good. 3 divergences. That's it. That's the deal breaker. Good stuff, guys. And I like it when I see everybody taking the same trade, but you guys are all taking it your own way, if that makes sense. It's the same conditions on the large chart, and you guys are creating your own plan. And I think that's the key. Woo! Strong triggers, clear path. Entry at 1-to-1s inside of triggers. Did it go down from the higher point trading book? It looks like it started back down off those large triggers. I don't have the ES up. No, they didn't. It ripped right through them. So, when we talk about the KISS plan, that one thing that we talk about No, these had nothing to do with it. There's a couple different things going on here. These had nothing to do with it. It ripped right through those. So what happens is, you notice how when we talk about the language of the correction point for the highest probability trend trade, and this is why I'm curious what happened next. Here's one large trigger. I like it, right? And it's even got a line in it, and that's pretty cool. But they also have the synthetic trigger all the way up here. Which means that when I'm brand new, my rules say that my stop has to go 4 to 5 ticks beyond that highest trigger line. Do you remember that rule trading book where we talk about that real simple plan for management? And then here's one of the decisions that you have to make is, if I get in at this correction point, am I willing to risk it? And if you are, totally cool, and it looks like it would have kept you safe while that thing was going back down, and I don't know what happened next. So when we talk about your best case scenario, and remember that this classroom is designed to give you the highest chance of success. Initially, one of the easiest ways to do that is with the favorable large triggers, where they're literally one on top of the other. Because what happens is, we expect price to come back to the large triggers, we expect price to come back to the synthetic triggers. And when they're overlapping, well, then they're in one spot. And when they're split, well, hell, it might go to that second one, right? Do you see how this creates indecision? And this establishes precision. And I'll drop this one in the room for you. It's in the spreadsheet. So initially, what you get is that this is your best look always. And as soon as those triggers find themselves way apart, it becomes more difficult to understand and be as precise. Does that make sense? And then what happens in Trading Book, and I know that you guys that aren't there yet hate the idea of the progression. But what happens later is, let's say perhaps this termination condition reverses the market, right? And it's the best trigger look ever. Maybe I'll take a shot like this and give it a little bit of risk outside of this correction point. And if it fails, if it goes to that one that's way off in the distance, I'm not going to ride it out. I'll take a little hickey and maybe try again up top. Does that make sense, everybody? So when they're split, you've got to decide, how much am I willing to lose? But when they're split like this, the only way I'm taking this entry is if I'm coming right off of a termination condition and it's absolutely screaming. Because I like advantages. So in the beginning, focusing on those favorable large triggers create an advantage. Absolutely. I'll never tell you how to trade. I'll never say, so only take it if they're overlapping, because it's not my place to tell you how to trade. It's my place to tell you that this creates a lot of indecision, and you'll have to make a choice on it. But the way I teach the class every day is, I say that if you want the best of the best, this is it. Don't have that for you, Trading Book. You'll get that as you study. You'll begin to recognize patterns. As you take pictures, you'll start to recognize patterns. You just told me that I had to keep it simple, and I should encourage you guys to keep it simple. And then you just asked me what other cases there are and in what order they should be. This is simple and clear. And then I promise you, you'll grow from simple and clear. But in the beginning, doesn't it make sense to give yourself the highest chance of success as you learn to read your indicators, as you learn to recognize patterns? This is the look for the highest probability trend trade that you can take, Trading Book. This is the best entry. This is the highest probability entry. This is the lowest risk entry. This is the most precise entry. I'm not sure what other adjectives I can use to make it sound like this one has the most warm fuzzies. It's all right. We're just learning right now. Ask a million questions. But my answer is always going to be the same. I'm always going to push you right back to the most basic, highest profitable probability trade ever. All right, Paul, 50-50, strong bottom. Man, can I make that bigger? The small triggers definitely didn't smash through. Would you agree, Paul? Why don't you DM it to me and I'll work it in? Did you see the gap theory in play? Sometimes we miss that in the moment. Because Trading Book, if you're making suggestions for new users as a new user, then you're just saying, hey guys, here's my opinion, follow it. DM it to me. That's it. No, I'm not gonna, you guys are grown-ups. I'll tell you to cut the shit, and then you'll have the choice of whether or not you choose to or not, and then I'll be super polite. I'll be super polite, but salty is subjective. Sometimes, Trading Book, I'll tell you that you broke rules and you'll think I'm being salty and you'll get butthurt about it because you didn't think you were. I know, but it could be me, right? So who's going to block me? There's rules for the room. There's rules for the room. Paul, did you recognize the... Let's get to Paul's chart. What do you say? Instead of talking about this high school BS. That's my thought. Guys, I don't go parental in the room very often, but I'm about to. Let's focus on rules. Let's focus on trades. Let's focus on feedback. Let's focus on learning to read the indicators. And if you have a problem with someone, DM me privately, and I'll have the conversation. But nothing else about it in the room. This isn't high school, ladies and gentlemen. You've made it to adulthood. So guys, there's this phenomenon, and it takes a little bit to recognize it. It takes a while to be able to pick it out right in the middle of things. And when price accelerates away from those large triggers, let me see if I can make it a little bigger here, and hit something, whether it's a fib or a mid band, and this is actually what it looks like when the mid band is behaving as a termination condition. If these large triggers lag behind and there's room for an entire bar to get back to them, this is what we call the gap theory, guys, and price is very likely to close that gap back to the trigger. And Paul had a good looking read there, and Paul, I think that was the only thing that sidestepped you on this one, is that big gap. They just weren't ready to rock it to the upside yet. Not yet. And the gap theory got you there just a little bit. But you're absolutely right. It's a strong bottom. The momentum was coming, but that termination got you. Man, it took me... I understood the concept of the gap theory long before I could recognize it in the moment. True story. I knew the rules for the gap theory. I knew that if those large triggers were a full bar away, that I shouldn't be doing it. And wow, this looks almost exactly like it. But what I always did in the beginning, in my own personal journey, is I would get so excited about that long trade. I would get so excited about the idea that those fibs stopped the market, that the momentum turned, that I would miss this. And I had to incorporate that into my thought process. And then your entry, once again, there's those split triggers, right? If you took the first shot, Paul, it still didn't work, but by then it just kept getting worse and worse. And that was just that gap theory sucking it back. They got you. Good morning, Miss Cindy. Great post, Paul. Good lesson in that one. Good lesson in that one. And that's why we focus on all those basics first, and we focus on those chart reads first, because all we're doing is we're piecing together all these little individual pieces so that we can catch it in the moment. Steve Diego, everything says down. You clear the mid band. There's nothing in the way. and you said with this much momentum everywhere, I'm just going to make $300 and get out of the market, and then I'll come back and find more trades. And guys, I'm telling you, 6 seconds. That's darn near a rodeo trade. Nicely done, Steve. Momentum and clear path for the win. Can I say that again? Momentum and clear path. Momentum and clear path. Every day I say, once you guys figure out momentum and clear path, you're going to find a million ways to get paid. Momentum and clear path and finding ways to get paid. Ron, that was the most timely post ever. Thank you for that. Once you figure out how to identify through rule number 1, momentum, and once you understand how to make sure that there's nothing in the way, guys, there are so many opportunities in this market. There's so much potential for money. And then Paul, directly into a termination condition, right? Smalls didn't break through the divergence high. You do have the momentum. You do have the momentum. Man, you do have the good bottom, but you are directly into the termination condition. So we're 0 for 2 on beating that nasty termination monster. Yep, that divergence high. And that's about the most ignored divergence, or the most ignored termination condition. Because I don't know why, for whatever reason, people just decide that that's not as important as the others. So much so, Paul. And guys, I like to always let you know that you're not alone. You guys are not alone. You're going to make the same mistake that everybody before you made. You're going to make the same mistakes that I made. The cool thing is I learned how to fix them. So I just teach you how to fix them. When we talk about termination conditions, those cyan divergence low lines, those magenta divergence high lines, I kind of broke it down for one of our clients on what it means. Anytime the market has a divergence low or high, guys, that's a specific point. That is an exact price where not only could the in control force, so like if buyers are pushing up, they're the in control force, or the sellers are pushing down, not only did the buyers shut them down completely, or the sellers shut them down completely, but they lost their momentum as well. And what it becomes is it becomes this line in the sand. And they always go and test these lines in the sands, right? Buyers and sellers rarely give up on the first push. That's one of the things that cause these fluctuations so much. And that's how these become in the termination condition category, because this line in the sand is literally, you can see without question exactly where the sellers stole the momentum from the buyers, the exact price where it happened, and you'll begin to picture in your head that there's this ugly mob of sellers right here just triple dog daring the buyers to try to cross it again. And it's pretty cool how that works. So good picture there. Great picture, Paul. But that is the most forgotten divergence. And if I'm trading into a termination condition in my own personal world, guys, that's the one where I tend to be the loosest. All right, let's see where we're at. Pete? Get off of there. I can't see it. So this is a test trade. I like it. Notice that, I love this. Notice that Pete's on simulator. This is a test trade, still proving the theory. When the market makes a weak bottom and the market shoots up well past the midband, you've noticed it has a tendency to return to the large triggers on the 5-1. And Pete, these are the synthetic triggers. So what you're identifying is the gap theory. This is 100% the gap theory. When you hit the midband, yeah. So what does that do? It keeps you calm. The problem is trying to time out the gap theory. And that's what you tried to do, is you tried to time out the gap theory to get down there. And this is the challenging part that I've found, because it does go past it sometimes. It's much easier at solid fibs. And that timing part, there is somebody in the room, I don't remember who it was, But he was using a market flow chart and insisting on a market flow confirmation signal for gap theory trades. But you nailed it. The weak bottom is first. Getting to the mid band is second. Large triggers don't follow. And there is absolutely opportunity there, without a doubt, to close those. And that's the challenge, right? I love to see 1-to-1s or something up here, Pete. And you even got a close on the right side of the small triggers. I mean, you took it. They just pushed up higher. One thing that you can do, but you don't always get your entry, Pete, is let your small triggers roll and sell the little snapback to the small triggers, because price tends to come back. And this way, you've already got a pivot and you've already let the momentum change. Does that make sense? And guys, this is advanced, right? But Pete drops it in the room. Let me tell you, let me give you everything that I have rattling around my brain that might help you. Letting those small triggers roll creates a little bit of an opportunity, and it usually snaps back. And yeah, Jerry, using the market flow is one way too when you're going to try to trade these gap theories. I have people that wait for the divergence to print. Some indication that it's on its way down for real. Good stuff, Pete. Thanks for posting that. I love that you're on simulator for it too. You're like, you know what? I'm working on this one. Let me sim it until I'm comfortable with it. Let me not risk real money trying to learn a lesson. What a concept. That's responsible. Miss Adriana, everything says down, you have momentum, the potential to break, you take the pullback to resistance right at the triggers, and you make money all the way down. Adriana, are you in here? Are you on your scooter already? She may have already jumped ship. Yeah, great job. Isn't it easier when you don't try to be first? When you wait for momentum? It's so stress-free. I'm so glad to see you back in the room. I'm so glad to see you back in the room. Maybe, just maybe, you didn't need that third chart to be successful. Welcome back. All right, Kurt, let's see what you did. Uh-oh. Kurt's link doesn't want to come up. Let's try again. There it is. Kurt says, Mark, check it out. I got momentum and a clear path. I'm just going to go ahead and get in at the mid band. Kurt, can I ask a question? When you took this trade, I love it. Was your stop on the other side of the synthetic triggers initially until you got that reversal bar? Did you play into the idea that that it may go up there? Oh, have a safe flight, Christine. Because this is the one. Some of the things that I see is people take these trades when they're a little split, and they get stopped out when they're still in these triggers, guys. And it's a little more risk. But with the termination that reverses the market with the odds favorable, Trading Book, you were asking about what's one of those instances. This is one of those instances. When a termination reverses the market, when I've got the perfect look on the large chart, clear path, everything, that's one of those instances where I may get in low and keep a little extra risk on it. So I'll point them out as I see them. Headed back to the Sunshine State. Great trade, Kurt. And then Zorro. That's a 5-1. 13-2 has odds favorable and a clear path. And Zorro says, you know what? I've learned how to take advantage of this market. Easy money. And you use the HVA line you just jumped in? Right on. 46, 46. One of the things that works great with this one as well, Zorro, see that breakout bar right there? That's all you're doing is you're just anticipating that break, that HVA line. So you're seeing it before it forms. Great job, dude. Nice trade. Again, odds favorable, clear path. Odds favorable, clear path. How many times am I going to say that today? I'm going to say it a lot today. I'm going to play my broken record card today. Andrew. Tail end of momentum. Not quite a clear path. You notice how it's a 50-50? So here's a good lesson. Andrew, and everybody in here. I'm going to take a picture of Andrew's chart. We're going to talk about it a little bit. So here's that look, guys, where 50% of my triggers are through and 50% are not. And this means that fib at 28.50 is not broken. It has the potential to break. Does that make sense, everybody? This is where understanding the very basic concept, understanding the idea that this isn't a high probability scenario, that it's not in fact a clear path. And this takes us, Andrew, to that second trade on the KISS plan. And let me pull it up real quick. This is such a good picture. I appreciate you on this one. So the second page on that KISS plan, you're okay, Kurt. We can go back to it. I'll go back to your chart because I did have a question for you on it. So guys, when we talk about the KISS plan, and we're talking about this 50-50, this is the best of the best way getting in. But Andrew, for yours, it's not so much about whether or not it's a 50-50. This is more of a lesson, guys. Understanding what you're getting into so that you know how to manage it. So one of the things on the KISS plan says that divergence is one of the biggest indicators that your 50-50 may fail. Divergence is one of the biggest indicators that 50-50 may fail. So much so that it says no divergence, no trade. And even in management it says if divergence prints, get out. So it literally is one of the biggest reasons 50-50s fail. Take care, Adriana. So some people will take it. Some people won't. That's totally up to you. But what it does is it gets your management hat on. Is you start saying this isn't the perfect trade. This area isn't completely broken. Your entry is rock star. Beautiful entry. And then the second this second divergence prints on a 50-50, man, that's kind of a deal breaker. So Andrew, I love your entry. And this 50-50 just didn't work out. The area wasn't broken. And divergences. So remember when we were talking about the small chart will show change that you can't really see on the large chart yet? Your large chart was doing great. Hey, good morning, Paul. It's caught between fibs? But your small chart was telling you, hey, guess what, Andrew? We're slowing down a little bit. We may not have the oomph to break that area as easily as you want us to. So you just have to manage a little bit. So great job. Did that make sense, Andrew? But I think it goes back to understand what kind of trade you're getting into. So you know, like you go into that trade saying, all right, it's not perfect. I got my guard up, right? I've been hurt before. Not going to fall in love with this trade. Not this time. And you keep your guard up a little bit. Great job, dude. Great job. And then Kurt. There it is. First and foremost, Kurt, Rockstar large chart. This is the best of the best look on the large chart. That was a termination that none of the triggers got through that reversed the market, guys. That's a strong top. The buyers were pushing up with just reckless abandon, and the sellers shut them down instantly at the key area. That's huge. And they got shut down so bad that they created momentum the other direction, and they hadn't reached a new area. So momentum and a clear path. Once again, guys, the battle cry. And then, Kurt, the only question that I had for you And this goes back to the idea that when we look at the small chart, I want you guys to think in these terms. Price corrects to the large triggers, and there's large triggers there, and I mean, it dissected it before you ever got a reversal bar. Clearly that's out of the equation. And then your other large triggers are right here. And your only area is the actual fib, not the mid-band. Does that make sense, Kurt? But the mid-band is on its way to the second correction area. Nothing wrong with that entry. You just have to be prepared that it goes up a little higher. And the question that I was asking is, was your initial stop on the other side of those synthetic triggers? Because I think that this entry just begs a little bit on the management question. If your stop was anywhere before resistance inside of favorable large triggers, then you were chumming the waters, right? But if you said, hey, I know where my stop should go, it should go to the other side, I'll put it up there because I trust this look, and once I get a reversal bar, my risk is going to be virtually nothing anyway. And I was just curious if you did that. 12 ticks by default. And that's why I asked the question. Because 12 ticks is close, but it keeps you inside of that correction point. And one of the reasons that we do 12 ticks, guys, is it's not what the stop is. It gives you reaction time to put the stop where the market shouldn't go. And it's pretty awesome that you can do that. You can put your stop right where the market shouldn't go. And 4 or 5 ticks beyond. But that 12 ticks is reaction time. And Kurt, you're fine, right? Because you're going through it. You're learning it. You're getting better at it every day. And you have the courage to post in the room. So we can have these talks every day, dude. And I promise you, you're going to get better every day. Just keep posting. Keep posting. Keep telling me what you see. And if I see anything at all where I think that, hey, maybe we could do this a little better, then we'll work on doing it a little better. Zora, I don't even have a doubt here. Odds favorable, everything says up, and Zora's like, hey, check it out. Let's go long and make money. Oh, look, it pulled back right to those synthetics, and there's an area there. Let's go long and make money. And notice that the large chart led the way. And then you did the same thing with the short trade, right? You were going down and got paid. Guys, momentum and clear path for the win. Momentum and clear path for the win. And then look at that mid-band right inside of favorable large triggers. That's the one, guys. Easy money. And with this look, that's just another trend trade to keep going. At this point, Zorro was just sick of making money. He's like, I'm never going to be able to spend all this stuff. I'm going to skip this trend trade that is perfect at support inside of favorable large triggers because I don't need that extra 3 points. To hell with it. I'm exhausted. I need some Gatorade. Great trade, Zorro. All right, Andrew. Oh, we talked about this one. Oh, Zorro, that means that I accidentally skipped yours. My apologies. And then Paul, no, I'm sorry, Pete, directly into a termination condition. 3 divergences. It's just a tough trade, man. You've already got the termination here, and then you get the validation of the termination through 3 divergences. I think you could have gotten out without a loss there. And that was actually 4 divergences on the small chart. So, do you see the termination though? Because you called it a clear path. And anytime I see you guys call out clear path and I see a termination, I want to make sure that you understand that that divergence high is very much a spot that can stop the market. Yeah, people do for some reason. And then Ollie, your biggest challenge was the waiting part. Yeah, everybody. Mine too, still some days. But after a few weeks of reviewing your daily charts after market close, you realize how important it is to wait for for the high probability, and it helped get rid of. Thank you for sharing that. You just developed trust, and the fact that you went back and studied, guys, that sets it apart. Is not just believing that a trade is going to make you a great trader. Guys, it's the study that's going to make you a great trader. There's too many emotions involved in a trade when you're brand new. But going back and looking at them, you don't have those emotions anymore. You don't feel that anxiety. Did we already see this? No. Steve Diego, man, I saw this one and I thought, dang it, Steve reposted. And Steve, I got to tell you, that is probably one of the best things I could ever say about your trades, guys. Is when I think that the trade you posted second is just a repeat of the trade you posted first. Because what it means is that, Steve, you have a plan, brother. You have a plan, and you know exactly what it takes to get you in, and you know exactly what it takes to get you out. And beautiful. Momentum and clear path, once again. What are we up to? Like 30 momentum and a clear path for the win? Steve, great trade. Honest to goodness, though, I thought that was the same trade for a minute. And that's amazing. And then Kurt. Odds favorable, clear path. You get in on a little fluctuation and out at trouble. And then you just trailed that one to make a little extra money. Nice job, Kurt. Not a high probability trend trade, right? Because you're not in an area inside of triggers. But once again, if you're getting in here, your stop has to go here. It creates opportunity. You're making sure you don't miss it, and you didn't. So not completely high probability trend trade, but a great use of momentum and a clear path again. Not again. Momentum and a clear path. Get in, get paid. Missed you by a tick, the bastards. I like it when you guys swear at the market, because we've all done it. But when you take the time to type it out, it's rad. I'm going to turn this into a lesson that Pete probably doesn't need. So it missed the fib by a tick, guys. Missed the fib by a tick. I'm going to show you how fibs are born. And this may or may not adjust your ideas on where your target should be, guys. But when you open your software measures every swing in the market, every up and every down. But it doesn't just do it like in the moment. It goes back 10 days historically, and it creates synthetic time frames, and it measures those swings, and it projects forward and backwards. And there's thousands upon thousands of calculations, individual Fibonacci calculations. And then from all of these lines, and this is one of the reasons that my brother's been so successful in this business for almost 30 years now, is that it automates and it goes through and it weighs them out and it sorts them and it decides which ones are most important and what the most highest concentration is, guys. And from all of this chaos, you get that big fat line, which means that there may have been lines a couple ticks above and there may have been lines a couple ticks below. And that's why you see the market exceed a little bit, right? And sometimes it exceeds it by a couple ticks. But understanding that there's that many lines that create this one line, maybe it'll make you say, you know what? I'll go 2 or 3 ticks below it. I'll sacrifice that $20 to make sure that I don't get stopped out, or that I don't, give it all back. One of the things I always did, Pete, is if my target was right there and it missed it by a tick, I'd run my stop way up close. I'm like, I'm not giving back $150 for the sake of $10, right? I'll give back 20 or 30 and it can come get me. So guys, understanding how those fibs are made might help you make decisions on targets. And we've all lost out to that one tick. I don't think I've ever met anybody that hasn't, at least once. And then there it is, gap theory. Mid-band triggers are a full bar away. And this is, I know you're working on your theory, Pete. divergence, and then taking the entry. And notice that it's also the snapback to the small triggers that rolled. That's kind of the double whammy there. Was that not you? Who was testing the theory on the gap theory? On simulator? No, I had a picture earlier. Yeah, that was you, Pete. I know this is Ron's picture, but Pete, I was taking Ron's picture to go back to what we talked about. Some people wait for divergence, some people wait for the snapback to the triggers, and Ron actually did both here. Helps define it a little bit. Yeah. Guys, the gap theory is a pattern, right? The gap theory for 99% of you says don't go short yet. For the 1% of you that have put the time in, that have studied, you're going to find an opportunity to take it the other way. And it uses the idea that price loves to come back to those large triggers. Great trade, Ron. And I love the patience, because I know right here you were absolutely chomping at the bit, just waiting for that trade. And it didn't give you that divergence that you like to see, and you sat on your hands and waited, and it paid off. That's hard when you know your trade's almost there, but it hasn't set up the way you need it to yet. That's where you start chewing through pencils. At your age, waiting is easy. Yeah, because they don't bring the tapioca around till what, 4:30? So, whew, you gotta wait. All right, Morgan. Strong bottom. Absolutely. Odds favorable. Without a question. None of your patients are patient. That's right, Andy. That's your job, huh? Does this make it a 50-50? So, Morgan, based on the couple lessons that we've had since you've posted this, what do you think? I want to see if you can answer your own question, and if not, we'll go into the lesson for sure. Does this one fall under? It is without a doubt, right? Because those divergence highs can mess up our good time. And then I like this. One divergence, but smalls are far outside of the large. So you said, I'll take it. I'm willing to risk it. There was a divergence, but the increasing momentum and strong bottom, you're willing to take a risk a bit for small targets. Beautiful. So once again, broken record, dead horse. Morgan took a trade where the KISS plan, the best of the best, the optimize your chances of success rules say that there's no trade to take. Does everybody get that? And some of you are thinking, Morgan broke the rules. Morgan broke the rules on the KISS plan, and we're going to play trade police a little bit. And we're all inclined to do that for whatever reason, right? But it says no divergence, and it says if there's divergence, don't take the trade. And what Morgan did is Morgan used his simulation, his study, his class feedback, and continuous practice, and he created a plan tailored to his personal goals based on his ability, his experience reading the indicators. And Morgan said that because of this termination that reversed the market, because of this level of momentum on both charts, he's willing to ignore one divergence, especially when he has areas right inside of those triggers and he knows exactly where his risk is going to be. And Morgan, gold star. Absolutely 50-50. Everything you did was spectacular because you took your chart reads, you took your ability to recognize advantages, and you were able to create an opportunity for yourself. You learned your rules so intently that you figured out how to break them. And you haven't been seeing things the past few days. Do you want to address that? Because I know why. And it's coming with praise. Morgan, there's absolutely no doubt in my mind that you've studied momentum, and there's no doubt in my mind that you've worked hard on these termination conditions. And I remember when you got to the class, and I hope you kept your pictures. I'd love for you to compare some of your current pictures with what you were doing when you first got to me. And there's no doubt in my mind you understand entry areas, right? And remember, that's what we used to work on. You used to just jump in, willy and nilly. And we got there, right? And that's important. And what you did is you became a chart reader. Would you agree that you've gotten pretty good at reading your indicators? You can start looking at things and saying, man, this is exactly what it's telling me. And here is the only downside of becoming a chart reader, guys, is when you learn to read your indicators, when you start to understand these patterns and they start looking familiar, there's a little devil on your shoulder, Morgan, that's going to convince you that you should be breaking your rules. That you'll use phrases like it should, it probably, I think it's going to. And what happens is you're beginning to recognize patterns. And guys, your chart read is huge, but your chart read has always got to take you back to your rules. Your chart read has always got to take you back to your solid trading plan. And what happens, Morgan, is when we really start to get good at chart reading, that's when most people start to break away from their rules or create confusion. Because their chart read maybe doesn't line up with their rules, but we feel so convinced that our chart read is solid that it creates a conflict and then we just freeze. Does that sound about right for anybody other than me that's done that? So one of the things that I always encourage people is the better you get at chart reading, the more important it becomes to make sure that you know exactly what it's going to take to get you in. The more important that it becomes to have your rules, Morgan, printed out right in front of you. Don't ever convince yourself that you know them by heart, no matter how long you've been doing this. Have your rules in front of you. I still do. When I trade live money, I have a checklist in front of me. I have my rules in front of me. And it's crazy. I've had days where I'm like, I can't figure this shit out. And I still haven't. I've been doing this for years. And there's days where my brain overrides or tries to override my rules, and I have to fight it tooth and nail. And you have it printed and laminated so that you can use an expo marker. I think that's awesome. That's smart. But what you just did, Morgan, is you took this 50-50 plan and you said, if from a strong top or bottom, I'll ignore one divergence on the 5-1. So what you did is you adjusted your plan based on your experience, right? So Morgan, you need to go make that change. You need to go make that change in your plan, written out, so that you're not breaking rules, so that you're just following the rules that have evolved. Does that make sense? Because that's what's going to happen. You want the KISS plan, Gary? Here it is. Here, I did it in PDF too, so it's easier. There you go. Wow, that wasn't it. So there's the KISS plan and PDF, both of them for the 50-50 and the high probability. But guys, it's the most amazing phenomenon when we start to get smart. We start to digress a little bit from following rules. And it's the weirdest thing ever. You would think that we would adhere more, but we typically choose not to. All right, strong triggers, not so clear path. I love that. That's a great read, Trading Book. How about strong triggers, not at all a clear path? But great read. Those are amazing triggers. But there is nothing clear about that path. But can I tell you something? Dude, your entry is rock star. Your entry is rock star. And there was potential to make that $100 and not give anything back. So Trading Book, Do you see how you took the very basic concepts? You took momentum. You understood that it wasn't high probability because of that big red line that's ruining the party. But you nailed the perfect entry. And because of that level of momentum, it gave you time to get paid and manage. And this is about the greatest example. This is about the greatest example of why those very basics carry you into the next level. Nicely done. You took the divergence out today. What does that mean? You took it out of the equation? I don't know what that means. Still don't know what that means. You're ignoring it? Okay. We are not speaking the same language right now, but that's okay. Because you're formulating your plan. You can show me a picture. On the stop loss. So if divergence prints, right on. Knock it out. And guys, as you develop plans outside of the KISS plan, you know that you're always welcome to send them to me, right? I'm more than happy to give feedback. I won't tell you how to trade, but I'll give you my 2 cents on it. They don't. You've got plenty of time. I'll show you how. The Pete bounce trade didn't work. Dang it. And then one of my favorite things is your ability to recover, Pete. You've got to be okay with losses to be able to do what Pete does. I'm going to tell you that right now. The biggest thing that is this huge advantage for him is that Pete's willing to take a trade that fits his plan, and if it doesn't work, he starts looking for the next trade. And that little tiny loss here is more than made up for. And then with everything up, you're like, man, I'm getting to that damn fib. The only thing that I would say, Pete, and this is, and you don't have to, not everybody does this. One of the greatest lessons that I got is if I'm relying solely on momentum to get in, and you hold for bigger moves than I do, for sure, but if I'm relying solely on momentum, I'm usually about two ticks below the reversal bar. That way, if divergence prints, I can go ahead and exit ASAFP with divergence, because that is such a loss of momentum. And you've got it in your arsenal to grab hold of it again and take it up and finish the move. And what's weird is that 40 or 50 bucks that you save per contract, and I don't know if weird's the right word for it. Let me pull up a calculator. I want you guys to see something. If you save 50 bucks a day, 252 trading, that's 12 grand a year. At 50 bucks a day, we're not giving it back, right? And I know you wanted that fib. I know you wanted that fib. And when you're that far into it, it's cool, but you end up making very little, right? So there's different concepts, and Pete, you've got this. I don't worry about it. But this is kind of cool. And that's on one contract, 50 bucks on one contract, right? You had 4. 50 grand a year, guys, that's a lot. That's a lot of money for anybody. And it's these little things. It's these little management things that are going to help to pay dividends as you grow with stuff. And you knew it was going to the fib. It'd be interesting to understand, why you chose to have your stop just above the same midband that was going to get you in. And sometimes we do that without even realizing it. Sometimes you'll put your stop and then you get stopped out and you're like, son of a gun, I just put my stop at an area of support inside of favorable large triggers. Or I just put my stop right where I'm going to enter this trade again. And you're like, well, hell, I should have just kept it and put it down here. And you don't always catch that in the moment. And that's kind of an interesting thing. When I see this exit and this entry, I've done it. And Pete, I've done it enough times that, where is it? There is a picture in here somewhere that says don't put your stops where your entries are under management, because it's a pretty common thing, and we all do it, and we've all done it, and I've done it recently. But when you start looking into the future a little bit, you're like, okay, if it comes back to the mid-band, I'm back in anyway. Then you can either say, I'll just get out here and hope for it, or maybe I'll take 3 of the 4 off here, and I'll let 1 hold on just in case it makes it. And then I'll just put those 3 right back on at the mid-band just to get there. Good stuff, man. I appreciate how often you post in this room, because I still learn from you. All right, Miss Clara, question: which bottom do I pay attention to? There are so many answers. So the first one is a 50-50 that failed, right, Clara? Triggers got through. It's a bad bottom. And then when it pulls back to support and every trigger is above, and that's without a doubt a termination condition, right? And this is where it's so good that your large triggers couldn't even roll against it. This is the one that sets the tone for me. This one's already failed and it's pushed up and I've retested. So this is the one that I absolutely love. Does that make sense? This one initially, until this one happens, and it couldn't even roll the triggers. So that's just like bonus points. And then it starts going up, and there was probably an opportunity somewhere right here. And then on this one, you just jumped in, right? Should have waited for the pullback. I love your question here too. Pull back to the mid-band. Is it risky to enter here because price is on the wrong side of the triggers, or is it okay because in strong trends, mid-band can hold? So Clara, absolutely beautiful recognition that this is a strong trending market. And guys, there's a very definitive trigger look for a strong trending market. Let me pull it up so that you guys know what Clara's looking at and what she's asking. When the market moves 30 bars or more in the same direction, you're going to start to see this look right here where the small triggers ride the large triggers and you get that dashed line. And guys, this is what we call a strong trending market. This is 30 bars without a reversal bar, 3 or 4 Fibonacci areas broken typically. And you're going to see this look on the trigger lines. And there's a rule of thumb, and I don't teach it, but it's pretty common among traders, that as long as I have this look right here, I'm going to keep buying that mid-band until it doesn't work anymore. I'm just going to keep buying the mid-band until it doesn't work. And Clara, eventually it won't work. Eventually, it's not going to work. But the other side of that is if I get a termination condition, well, then I have to stop that process. So I'm going to keep buying it as long as the path is clear. And you've got to decide how much you're willing to risk. And this is where I might keep the 12 ticks on it, or 6, 7 ticks or whatever. That's up to you. But yeah, in a strong trending market, and I think we'll see what this one looked like. Because that's that same look. Strong trending and it clears the path, and that was at about 7:59. So let's see if we can go back and find it. There it is, right back to the mid-band. Something like that. So, I mean, because there's nothing to stop it. It's a free fall. How much are you willing to How much are you willing to risk on the strong trending market? So here it went down 7 ticks. I don't know what the number is. Are you willing to risk $100 to make potentially 200 to 300 to get to the fib? But you don't have that clearly defined stop placement. So it is an arbitrary number. You have to ask yourself, What am I willing to risk to buy the mid-band in this strong trending market? And here, there was virtually no risk, and here it overran a little bit. So you never know what you're going to get. And eventually it's going to fail. And you have to go into these trades knowing that eventually one of them's not going to work. How much are you willing to lose? Obviously, you can't put it like a tick or two. That doesn't make sense, right? A tick or two doesn't give it any room. So yeah, maybe $100. So you just found your number, right? And then Clara, what you may find is you find yourself with about 20 pictures of this. And you say, you know what? Out of 20 pictures, it never ran over more than 3 ticks if it was going to work. It almost never, or 8 out of 10 times, it never ran over more than 3 ticks. And you might say, you know what? I'll double that. I'll give it $60. And if it stops me out, that's cool. It's $60. And you know what? If I get a reversal bar off of it, hell, I'll get back in. Does that make sense, Clara? And then you get 3 divergences, so that's your termination, which means that we're not buying the mid-band arbitrarily. Because the termination condition was reached, so we don't buy the mid-band. Let's see how that works out for us. Great question. Good picture. I like it. And guys, this is what we do every day, is we try to take that very basic, the most basic ideas, and just grow from them every day. And just grow from them every day. Get a little bit smarter every day. And Lord knows I need to get a little bit smarter every day. But I'm going to go back to this one because I didn't really read it. Guys, this class is designed to teach you 3 rules on 2 charts. That's my whole goal, is to stay so focused on the high probability trend trade that you guys know it and you hear me in your voice, right? You hear me in your head. You're about to take a trade and you're like, oh, Mark said that's a termination condition. But the skill set to recognize these advantages, guys, strong triggers, no termination conditions, and then finally the entry. And once you can recognize momentum, and this is the thing, you guys don't realize how smart you're getting by keeping it this simple. You're capable of seeing a market that's likely to continue in the direction of the trend, guys, and on its own, momentum is powerful enough to advantage to take and define trades in smaller size, quicker profits, right? That's that quick little get in and get out, little base hits. And then you couple that advantage with what we call the clear path without the termination conditions. Then you have a market that not only is likely to push in the direction, but there's no reason for it to bounce. There's nothing in the way. And I put in there, picture a semi doing 100 miles an hour down the highway. It's just hard to stop. And guys, these are the first 2 rules that I always talk about. These are the first 2 rules that I harp on. Because these 2 concepts alone are enough to create a trading plan that's consistent and profitable. And that's the thing. This is enough, right? But Mark, I want more. That's cool. There's so much more. But this is enough. And then, you know, once you learn them, once you study them, you're going to find your best entry. And that's the thing is guys, my high probability trend trade entry that I teach, it's not the only entry. Not even close. We've seen that today. We've seen you guys take all sorts of entries. But the one thing, and this is what I want to make sure that you guys recognize today, the one common thread for almost every successful trade today was momentum and a clear path. Did you guys recognize that? Did you guys notice that when people posted pictures with momentum and a clear path, it was typically a trade that won? Feel free to give me a Y in the room. Because once you believe that, you take the burden of knowing everything right off your plate. And you realize that you can be successful really with the bare minimums, right? It's like how I went through high school, doing as little as possible. There you go, Pete. Third crash, telling you to stop for the day, up $2,400. That's amazing, Pete. That's amazing. So guys, until you find your best entry, the high probability trend trade gives you the trade that embraces the advantages, that has the potential to win 70 to 80% of the time. It's a trade that helps you recognize the advantages of momentum, of a clear path, and you're just going to get it through repetition, through rules. And it's going to build confidence in those advantages. It's going to open doors for you for that next level. And the high probability trend trade is not your only trade. It's your first trade. And if you learn it, you're going to start doing what you see other people in this room doing. You're going to start seeing all these other opportunities that present themselves. So the first hour of every class is designed to teach momentum, clear path, and how to enter, guys. You're going to get everything that you need. And then the next 2 hours is how we all grow together. By showing me what you're doing, by showing me your chart reads, by telling me your plan. And I'm going to tell you right now, guys, I learn from you as much as you learn from me. I take things that you guys that started recognizing patterns and have worked them into trades. Guys, I steal them. I don't mind at all. And I don't mind asking you how the hell you did it. Because they're good and they're based in logic and they're based in advantages. And the same way I try to give everything that I have, what you'll find is that most of the people in this room are very willing to share what they do as well. Look at that, 3 divergences and it's going down. 4 divergences. Isn't that kind of cool that you can do that? And guys, it's an amazing community. And we're all people, right? And there's going to be days where I have a bad day. There's going to be days where I get a giant hole in my head and I come in the next day and I'm a little high on painkillers. And for those of you that witnessed that, my brother thought it was hilarious. I thought it wasn't that great. And we're going to have days where people say stuff that pisses us off. And we're going to have days where I say things that piss you off. Work through it. Because ultimately we all have the exact same goal. And that goal is to become profitable, to be able to quit our day jobs, to be able to provide for our families, to be able to do all the things that we want to do. And there's an easy way to do it, and there's a hard way to do it. And Belt Jr., Belt JR1, no, it hasn't. Great recognition, man. Great recognition. What do you... Well, you don't have... So, this blue fib, this fat one and this skinny one. Yay, we get another lesson. Let me show you what those are. Thank you for posting that picture. I didn't even know that we needed this lesson today. So, on your large chart, what you have, and this is a good example on the picture that you showed as well, you've got areas from different time frames, and this is one of the accuracy things that comes in. This is one of the days we can be so freaking precise. So any skinny line, and it looks like it doesn't go off to the right? It doesn't continue all the way to the timestamp or to the price bars. This is actually from a 5-1 chart. This is from your lower time frame, from your entry chart. This big fat line is from a 21-3, which is actually a time frame higher than your large chart. And then anyone that goes all the way through is native to the 13-2. So you're going to get these different looks. One of them will extend, and then the other ones won't. Guys, here's the thing. They're all equally as important. They are 100% equally as important. But what you notice there, Belt, is that on your synthetic, on any of your synthetics, you won't get that print. 1-to-1, synthetic, even the mid-band. It'll remain gone behind the most current bar, and it won't actually print on your screen until that bar prints. And that's just a part of the software. It's just one of those things. So just because there is, and this came about from an awesome talk with someone else, you're thinking to yourself, dude, I can shoot the curl here, right? I can blow through that hole that they left for me. It's not a clear path. As soon as this bar is done printing, that's going to print as well, along with the mid-band. Does that make sense? Good recognition. I never recognized that. It took 3 years, Belt, to have somebody literally point that out to me. And I had to go to my brother. I'm like, okay, John, why does it stop? And he went through everything. But you'll see it on 1-to-1s. You'll see it on mid-bands. And you'll see it on all the synthetic time frames. And it looks like divergence will continue through. That's good stuff. 3 divergences may stop the trend. 3 divergences might create an untradeable bounce. 3 divergences is a termination condition on the small chart. Isn't that awesome, guys? So Clara, that's when you don't buy the mid-band. Good stuff. We still have a little time. Is there something you guys want to talk about? Is there... Oh, hold it. Ron posted one. He said he's done for the day. See us in the morning. Nice. Hey, look, guys. Momentum. Clear path. Easy money. 11 ticks. 6 lot on the S&P. $825 and done. How easy is that? It doesn't have to be hard, guys. But there it is again. Momentum and clear path. Rob, I want you to realize that you don't need it right now. Because your brain is really trying to convince you that the gap theory is this integral part to what you need to be doing. Can you recognize it now? Do you know the rules for it? So why are you making it difficult on yourself? What does the gap theory do, Rob? It says no more trades into that area, right? Ron, beautiful trade. It just says no more trades into that area. Here, let me find a picture. I like it. And it's funny because sometimes we grab hold of these things, and I know I do too. Hey, stay dry, Ron. So check it out, Rob. Price reaches the area, right? And the triggers don't break. That's a termination. 100%, no matter where those large triggers are. Can we agree that that's a termination condition? That's the first piece. That's taking the basics. You good with that? Price reaches support. Triggers don't break. No short trades. Cool. When the triggers are super far away, all it says is, hey, Rob, in case you thought you were going to pull one over on termination conditions, don't. It's likely to close the gap. It doesn't say go long. It doesn't say that the trend is going to continue up. It doesn't say anything other than don't do it, brother. I'm validating and verifying that this is a termination condition. Does that make sense? There's no magic to it. Your rules aren't met anyway. That doesn't make sense? Okay, hold on, let me think. From the spreadsheet. Trying to find one that might fool you into thinking that there was a trade. That's not it. I'm going through my spreadsheet real quick. All right, so Rob, those one-to-ones still kind of... I'm trying to find one without a fib. So it's nothing but a mid-band. So I'm just going through all of my gap theory. Okay, here we go. Check it out. Rob, you have odds favorable momentum, right? On this picture. And you're like, man, I'm not worried about the mid-band. I'm going to look for a short. And maybe you've got something right here. Yeah. Background's red, smalls are red, large are red, space between, odds favorable. And maybe you're trying to convince yourself that I want to get in at yellow one-to-ones right here inside of triggers on the small chart because, man, I had a great top and I can't wait to go short and there's just nothing freaking stopping me. And then the gap theory says because you reach this mid-band and the large triggers are all the way up here, pump the brakes, Rob. Wait and see if they close the gap. That's it. That's all the gap theory does. Is it just says pump the brakes. It just, here's the best example ever. Odds favorable, right? Looks like a clear path. And Rob, you're like, hell yeah, I'm going long. And the gap theory says, Rob, just be calm, brother. We're probably going to go back to those large triggers. That's it. That's all it is. It doesn't say go long. It doesn't say go short. It doesn't say the trend is over. All it says is let's be patient and let price close the gap, and then we'll start the process of looking for a trade again. That's all it is. This is the look that defines the mid-band as a termination condition. So it doesn't have anything to do with a high probability trend trade outside of the idea that that's a termination, that rule number 2 is not met. That's it. That's all it is. Rule number 2 is not met. Into the mid-band. And every picture that I just ran through, they're all in the spreadsheet. But I think what you may be doing, and what I did too, and it cost me a lot of money, and I guess I'm trying to keep you from having the same run, is the only thing the gap theory has anything to do with in my world is the idea that I don't have a clear path. That's it. I don't care about the momentum. I mean, the momentum's going to be there, but it doesn't matter because I don't have a clear path. And it keeps me from looking for an entry area. It keeps me from wanting to find a trade on the small chart because the large chart says no. Does that make sense? Even here, we didn't even hit an area, and it closed the gap. Didn't even hit an area, and it closed the gap. Price loves to return to the large triggers. That's why we use the large and the synthetic for entries on the small chart, because price loves to pull back to the large triggers. Does that help at all? And you know that I'm going to start thinking of different ways to talk about it. But I think that the most important thing in the beginning is don't give it more than it deserves. It's just a termination. And then it creates an expectation. So if I had a mid-band right here, or any Fibonacci indicator right here, what it would tell me, Rob, is don't try this short. That's it. It would just say don't do it. Don't try it. It's likely to come up and do that. Does that help seeing the small chart with it? It says no. Okay means nope, it doesn't, Mark. That's okay. All lessons come together when they're supposed to. Keep focusing on that odds favorable. Keep focusing on that clear path. And Rob, what's cool is that you'll probably get caught by the gap theory a few times, but you'll have some real world application. And then you'll be like, oh, all right, this makes sense. Cindy, I'm so sorry you're having trouble. Just start fresh. That's the easiest thing to do. Just start fresh. Okay. Yeah, I forgot, Rob. That's my bad. I forgot that we get that way. But I think what will happen is if you stick to the rules, the way you have been, the way you've been doing great, Morgan, have a good one, man. You're going to New Mexico for Feast Day at the Pecures Pueblo. I don't know what that is, but anything with feast in it sounds awesome. Is that where you get real high in the desert and set things on fire? Be safe. Just be safe. All right, have a good time, man. Stay safe. We'll see you when you get back. And then, Rob, I think what'll happen... Oh, Burning Man, that's what it is. I think that what'll happen is you'll lose some trades to the gap theory, and when you post them in the room, then you'll have that experience to build from, and it'll be even more impactful to you. That's my guess. All right, guys.